Welcome. My name is Jeremy Addy, and I'm the president of the Rating Board. Thank you for joining us for our 2020 virtual forum. Instead of hosting you today in person, you've invited us into your homes and offices. We thank you for that. Now, those of you who joined us at last year's forum may remember seeing a photo of my daughter eating an ice cream cone during my talk. Boy, how things have changed. Today, we are 6 months into a global pandemic, and while there are many lessons learned, there remain many more questions than answers. For the past several months, while my wife worked at a local hospital, I worked from home, quarantined with our children, and found meaning in 2 questions that my 4-year-old daughter asked daily. The first question was, "Dad, can I watch a show?" We all want to make our children happy, and I want to say yes. But I learned early in quarantine that this question is a trap. If I say no, I'm destined for 15 minutes of conflict. And if I say yes, when that show ends, she is sure to ask, "Can I watch another show?" And I'm back to where I started. There's a parenting lesson to be learned here. I haven't learned it yet, but I have discovered that the desire to say yes and please is strong. It's human, and we have it at the Rating Board too. When our members ask for new online tools or enhancements to existing ones, we want to say yes. We want to please them. When stakeholders ask for data analysis or legislative analysis, we want to say yes and please them too. But we are also mindful of the very real tension between our human desire to please and providing objective analyses that may not please everyone. This tension is magnified when the stakes are high in a political environment. We know that it means that we may have difficult conversations with our member insurers, legislators, regulators, or advocates. Rising above this tension, reporting without bias, is what objectivity means. It is our purpose, it is our vision, and it isn't easy because we are human. We know that our analyses may not always be embraced, and that we may fall out of favor with some at times. And that's human too. But our job is to be objective and do the best that we can with the information available to us. Our job is to listen, understand, report to the best of our ability, and do it with intention. We recognize that while we strive for perfection, we're human, and we make mistakes too. And when we do, I assure you that we will take corrective action, because being objective also means being self-reflective and honest. Now, the second question that my daughter asked routinely was, "Dad, when is the coronavirus going away?" Kids have a way of getting to the heart of the issue. We don't know. This pandemic brings significant uncertainty and an endless parade of unknowns to an industry that relies on historical experience to make future projections. How many workers will contract COVID-19? And how many will file workers' compensation claims? Which claims will be compensable? To what degree has the stay-at-home order impacted claim frequency? Will delays in medical treatments and therapies impact medical outcomes? Will virus transmission increase in the fall and winter of 2020? And if so, will stay-at-home orders be reinstated? When will a vaccine be available? And will most people take it? What will the workplace look like in 6 months, 1 year, or 2 years? With early data offering only limited guidance, how do we prepare for what will likely be an extended period of uncertainty? The answer is that we prepare differently. We talk less and listen more, because listening poorly, selectively, or not at all limits our understanding of the world. And when we listen, we do so mindful of our biases, which are inherent in the human condition. And we listen with the intention of learning and understanding, not reacting. We challenge assumptions and traditional ways of thinking. We look to experts. We open our minds to learning in real time as events unfold. We revise our work often to reflect the most recent data, and we put ourselves in a position to serve the marketplace. Early in the pandemic, we knew that we could not identify COVID-19 claims with existing reporting protocols. So, together with our fellow rating bureaus nationwide, we made data reporting changes to enable us to identify these claims. But that wasn't enough. The time lag between the filing of a claim and the reporting of that claim to the rating board can be as much as 18 to 20 months. So we partnered with stakeholders to obtain anecdotal information as claims were filed. Now, as the disease took hold in New York and data samples came in, what mattered most became clear. These claims weren't just numbers in a spreadsheet. They were our brothers, sisters, parents, and neighbors who were getting sick in the workplace and turning to our industry for help. So we study these issues with a sense of purpose and gratitude for the opportunity to do work that impacts New Yorkers. And like every other New Yorker during this pandemic, we do it while taking care of each other, applauding frontline workers, and healing our communities. Now, while we prepare for the unknown, we have also remained faithful to our core mission, commitments, and work, and we continue to make progress in 2020. Multi-year efforts to refine and optimize some of our actuarial methodologies are being realized this year. In the spring, we implemented a new rate-making methodology that provides additional pricing stability for New York employers. And this fall, we will propose an overhaul to our experience rating program to increase fairness and safety incentives. Improvements to our data collection efforts could not be more timely. The first submissions in response to the rating board's indemnity data call are flowing in and will provide us with a better view of the marketplace. The Managed Data Application Partnership is growing, bringing additional consistency to data submission across jurisdictions. The Wisconsin Rating Bureau has joined the New York, New Jersey, and North Carolina partnership, and all four bureaus are working together to develop the next phase of enhancements. In New York, these enhancements will go live in December 2020 and provide several improvements for data submitters. Our growing actuarial team has continued to publish reports and studies, bringing transparency to the state's workers' compensation system. The 2020 State of the System report provides the latest marketplace insights and trends, while the 2020 frequency study and COVID-19 study drill down into some of the most important issues in our industry. These publications add to our growing body of work, available to all those who want a deeper understanding of the workers' compensation industry in New York. Now, while the marketplace has been changing around us in 2020, 2019 has shown itself to be largely consistent with the results we've seen in recent years. The calendar year 2019 combined ratio is 81.8%, which is just 0.6% less than the 2018 combined ratio that we reported last year. 2019 pricing was competitive. The New York State's insurance fund's market share dipped to 35.5%, and there was a wide range of approved loss cost multipliers in the state, which translated to competitive pricing for New York State's employers. Premium levels decreased by 5.1% in 2019, with 195 individual insurers writing premiums in excess of $1 million. And in July of 2020, the New York State Department of Financial Services approved the rating board's actuarially recommended loss cost level change for the 5th consecutive year. The overall loss cost level in New York State will decrease by 1% on October 1st, 2020, providing some level of stability at a time when we need it most. But we know that our core actuarial measures, premium, frequency, and losses, may fluctuate significantly in 2020, and we prepare for the unknown by listening with intention, opening our minds, and developing a deeper understanding of the world around us. We are excited to share some of our work with you today, We'll begin with the 2020 state of the system and follow that with the Rating Board's 2020 frequency study. We will close the forum by asking our panel of experts how the COVID-19 pandemic may impact our industry and what lies ahead. So without further ado, I'm happy to introduce the Rating Board's Chief Actuary, Ziv Kimmel. Ziv will present the 2020 State of the System. Take it away, Ziv.
Thank you, Jeremy. Welcome to the 2020 State of the System presentation. Many of the results and figures I'm going to share with you today are based on data that is fairly recent. However, some of it may be perceived as old news, given the new reality we all have found ourselves living through these past several months. But the data that I'll present to you today is still very relevant. This is the moment in time where the COVID-19 pandemic hit. We want to use the latest statistics as a benchmark to compare how things changed. We want to understand where things were before the pandemic and where we are headed in the future in a post-pandemic environment. It is also important to understand how we got to this point in terms of the 2020 loss cost filing and some of the changes we made this year. So let's get to it, and we'll start with some key figures. I'd like to focus your attention on two key figures. First, the negative 1% indication displayed on the upper left side of the slide. This approval represents the fifth straight year that the Department of Financial Services approved the loss cost change recommended by the Rating Board's Actuarial Committee. We'll discuss the loss cost filing in more detail later. Second, the calendar year combined ratio of 81.8% on the lower right-hand side. It is the second year in a row with a combined ratio in the low 80s and a historic low result. Again, I'll discuss the details behind the combined ratio later on. So here's the agenda for the presentation. As I mentioned, I will go into some of the details of the loss cost filing and discuss some changes in the methodology the Rating Board implemented this past year. I will then address the issues associated with COVID-19 and the impact of the pandemic on the loss cost filing. I will also share some very preliminary statistics related to the pandemic and its effects on the workers' compensation system. I will then proceed to discuss some premium and market share statistics. We'll then move on to loss statistics, and I'll conclude by bringing the premium and loss information together for a discussion on underwriting results, which will of course include the details on the combined ratio. We'll start with the loss cost filing. As was mentioned earlier, in July, the New York State Department of Financial Services approved the Rating Board's actuarially recommended 1% average loss cost decrease, ensuring that loss costs in New York State remain at adequate levels. Here we have a historical perspective of loss cost and rate level changes. The blue bars represent rate changes, and in October of 2008, we moved to a loss cost system represented by the purple bars. Interestingly, over the past 20 years, the cumulative change represented by the yellow line is a decrease of 4.6%. This means that on average, workers' compensation premium rates are 4.6% lower than they were in 2001. You can see that the 2020 approval is the fourth consecutive decrease, following the 4.5% decrease in 2017 and two consecutive double-digit decreases in 2018 and 2019. But if we focus for a moment on the right side of this exhibit, you can really tell that from 2016 to 2019, the loss cost level in the state has been relatively volatile, with more than a 9% increase in 2016, which was then followed by these significant decreases. So we have some volatility. So let's discuss the loss cost filing process, the steps we take to derive the overall indication, and as part of the discussion, I will point out what we have done to ensure we achieve the right balance between stability and responsiveness. There are several components to the loss cost filing. First, experience. In this component, we look at the latest 2 policy years of available data and measure how losses compare to premium. In the trend section, we want to see how these measures, namely premiums and losses, are projected to change over time from the experience period to the prospective filing period. To that, we add benefit level changes, which primarily result from changes in the maximum weekly benefits, and the projected change in loss adjustment expenses. We're going to take a deeper look into the experience and trend components. For the experience section, we examine how premiums and losses compare. The latest 2 policy years for which we have complete data are 2017 and 2018, and all of the data is valued as of December 31st, 2019. For each of these years, we're looking at both incurred loss amounts, which include payments and case reserves, and we also perform a separate analysis looking at paid losses only. Prior to this year's filing, our loss cost level analysis focused on incurred amounts only. We added the paid analysis to prevent some fluctuations that may result from temporary reserve changes that may happen during a particular year that would potentially add volatility. The blue bars represent the premium amounts for the 2 policy years. The reported premium amounts are at the loss cost levels, so they do not include the effect of loss cost multipliers. They are also adjusted to the level of the current loss costs because really what we're trying to measure is the adequacy of the current loss cost level. The red bars represent total reported loss amounts for the 2 policy years on an incurred basis and on a paid basis. These loss amounts are valued as of December 31st, 2019. We know, however, that regardless of whether we look at paid or incurred loss amounts, the value of claims changes over time as they develop until they reach ultimate value. So we have to adjust the reported losses to estimate what their ultimate value would be. We do that by applying a development factor. These lines represent how 1st to 19th incurred loss development factors have changed over time, with the blue line showing indemnity development factors and the yellow line showing medical development factors. What does that mean? How does a loss development factor work? As an example, a 1st to 19th development factor of 2.528 means that if a group of claims generated $1 billion of losses at first report, after 19 years, the value of the claims is estimated to become $2.528 billion. The incurred loss development factors remained relatively stable from 2008 until 2013, and then experienced a decrease. In fact, the latest calendar year development factor is the lowest we've seen. To promote stability, the rating board has been using development factors based on the most recent 5 years. In this year's filing, we're using the loss development factors from 2015 to 2019, and we're going to apply the resulting averages to the reported losses to get ultimate losses. Here, we're also looking at indemnity and medical development factors. But these are paid loss development factors, which are to be applied to the reported paid losses to get the ultimate loss estimate. We see a similar pattern with the paid loss development factors, as they have also exhibited a decrease over the past several years. Once again, to promote stability, we're using the 5-year average, which are the loss development factors from 2015 to 2019, and we're going to apply the resulting averages to the reported paid losses to get the other estimate of ultimate losses. This year, in order to address some of the volatility we experienced in recent years, we're applying an actuarial methodology that is intended to achieve more stable results, while still being sufficiently responsive to the latest experience. So let's talk about this actuarial methodology to estimate ultimate losses. So first, we're going to look at a hypothetical policy year to illustrate how it works. And then we will look at how it works in practice for the 2020 loss cost filing. And we start with a blue column representing premiums at the current loss cost level. But in effect, this blue column, because it represents premiums at loss cost level, another way to think about it is that it really represents ultimate losses that are underlying the current loss costs. So keep that in mind. It's another estimate of ultimate losses because this is what we targeted last year as the total amount that would be needed to pay for losses during the current period. We proceed by looking at undeveloped incurred losses, and we continue by applying the loss development factors to get ultimate losses. Under the old methodology, the difference would have been our experience indication for this policy year. But we're going to do something different. The red section of developed ultimate losses is the known information based on reported data. The yellow section is an estimate. So in this example, 31% of ultimate losses are known, and the other 69% are an estimate. Now, I have one estimate of ultimate losses in the red and yellow column, but remember, I also have another estimate of ultimate losses represented by the blue column. So my new estimate of ultimate losses will be a combination of these two estimates. I'm going to take 31% of the red and yellow estimate and 69% of the blue estimate to get a new combined estimate represented by the green bar. So this procedure acts to effectively stabilize the indication. The new experience indication for this policy year is the difference between the green bar and the blue bar. As you can see, it is much more stable. So now that we know how the methodology works in theory, let's go back to the two real policy years we're using for the determination of the experience component in the 2020 filing. Recall that in addition to employing this new loss estimate approach, we are going to get two separate estimates for each policy year. One based on incurred loss information, which includes reported data on payments and reserves, and a separate estimate which uses just paid loss data. Averaging the incurred and paid indications is intended to protect ourselves from overreacting to sudden changes in reserving practices or in settlement rates that may be more temporary. So we start with the incurred loss indication for 2017, following the same procedure I just described. We develop the losses to ultimate level, and we take a weighted average of the red and yellow loss estimate with the blue loss estimate to derive the green loss estimate. And the experience indication is the difference between the blue column representing premiums and the green column representing our estimated ultimate losses. And in this case, an increase of 1.7%. We then perform the same analysis, but this time we just utilize the paid loss information. We develop the reported paid losses to ultimate level, averaging the two loss estimates to derive the green loss estimate. And now, the indication based on paid losses is an increase of 3.6%. So the average indication for policy year 2017 is the average of the paid indication and the incurred indication, or plus 2.7%. We do the exact same thing for policy year 2018. After employing our procedure, the incurred loss indication for 2018 is plus 1.4%, and the paid loss indication for 2018 is plus 1.9%, for an average of 1.7%. So our experience indication for 2017 is plus 2.7%. The experience indication for 2018 is plus 1.7%. And the average experience indication for the two policy years is plus 2.2%. So we're going to go ahead and plug that in for the experience component. Let's talk about trend. For the 2020 filing, which has an effective date of October 1st, 2020, we used experience information from policy years 2017 and 2018. We have to remember, though, we are not trying to determine what the loss costs should have been back in 2017 and 2018. We're trying to determine the appropriate loss cost level for the future for policies that will be written starting in October of 2020, but also for policies that will be written in September of 2021, which will remain in effect until September of 2022. So we know our starting point is plus 2.2%. but we need to determine how the measures of premiums and losses are projected to change from the experience period until the prospective filing period, which is what we refer to as trend. So let's see what this looks like in terms of the timeline. So we start with the definition of policy year 2017. The first policy is effective January 1st, 2017, and expires December 31st, 2017. The last policy of this policy year becomes effective December 31st, 2017, and expires December 31st, 2018. So policy year 2017 really spans a 2 calendar year period. Similarly, this is policy year 2018. So when we talk about the experience period of 2 policy years, we're really talking about this period. The filing, as I mentioned, has an effective date of October 1st, 2020. And the last policy we're making loss costs for will be written in September of 2021 and will expire 1 year later in September of 2022. The midpoint of the experience period is July 1st, 2018, and the midpoint of the prospective filing period is October 1st, 2021. So when I say I want to project how premiums and losses will change from the experience period to the prospective filing period, this is the trend period I'm talking about, from the midpoint of the experience period to the midpoint of the prospective filing period. Now that we're talking about 3.25 years. The red line represents wages, and as you can see, they are increasing at a rate of about 3% per year. So over this trend period of 3.25 years, wages would increase by over 10%. More wages would bring in more premium. So just because wages are increasing, even if we don't touch the loss costs, premium volume in the state would increase. Now, if losses are increasing at the same pace as premium, then no further loss cost adjustment is needed. If losses are increasing faster than premium, then we would need to adjust loss costs higher. And if losses are increasing at a slower pace, we would need a downward adjustment. The blue line represents the total loss ratio trend. As you can see, it has experienced a decrease through 2016, but has increased since then. We are using the changes over the most recent 5 years to determine what the future projection line is. So because the blue line is increasing over the past couple of years, and after applying the trend projection methodology I'll discuss in a minute, my projection line is also increasing, but at a lower rate than wages. This creates a gap at the midpoint of the prospective filing period and results in a trend factor of -4%. Let's take a closer look at the different components of the trend factor: indemnity severity, medical severity, claim frequency, and wages. We'll start with indemnity severity. And we begin with the blue line representing actual indemnity average cost per case over the past 5 policy years. The black line represents the valuation date of the reported data. Based on the observed pattern of indemnity severity, we can tell that at least through the latest point of known data, indemnity severity is increasing at this projected rate, about 4.1% per year. However, from this point forward, we are not using the same growth rate. Instead, we're using a growth rate of a selected index. For indemnity severity, the most appropriate index is wages, because indemnity benefits are a function of wages. So here, the red line represents the wages, which again are consistently increasing over time, and the purple line is the projected increase in wages. And in this case, the projected rate of increase in indemnity severity is similar to the increase in the wage line. But we're going to go ahead and use the rate of increase in wages from the latest point of known data to the midpoint of the prospective filing period as the estimate of this change in indemnity severity. Let's examine medical severity. Similarly, the blue line represents medical severity, or average medical cost per lost time claim over the most recent 5 policy years. Although we notice some volatility, overall we observe a slightly decreasing pattern. So we project that from the experience period to the latest point of known data, there will be a small decrease at a rate of about 0.2% per year. For medical severity, we use a different index called the Chain-Weighted Personal Healthcare Index. It is published by the Centers for Medicare and Medicaid Services, and studies have shown that it is a pretty good reflection of the services that are performed in the workers' compensation system. This index has been steadily increasing at a very consistent rate, and the projection is that it will continue to do so. Using the same approach, we project that from the latest point of known data to the midpoint of the prospective filing period, medical severity will move at the same rate as the index. Claim frequency, which is the number of lost time claims per $1 million of premium, we use the same methodology as we did in the past. We don't have an index to tie it to. Claim frequency has been decreasing very consistently at a rate of 0.9% per year. We project that it will continue to decrease at the same rate. As we have seen earlier, wages have increased consistently and were projected to increase at 3.1% per year. The blue line is again the loss ratio trend, which is really a combination of frequency, indemnity severity, and medical severity. And the yellow line represents the projection, including all the index adjustments from the experience period to the prospective filing period. Again, the different growth rate for wages and for loss ratios results in a 4% gap at the midpoint of the prospective filing period. So this is the trend factor we put in the filing. So we started with experience at plus 2.2%. This is the trend section. We add on plus 1% to account for the annual increase in maximum weekly benefits, and a small change of negative 0.1% in the loss adjustment expense provision. Putting everything together, we get negative 1%. Of course, as we were preparing the 2020 filing, the COVID-19 pandemic hit. We did not make any adjustments to reflect the potential impact of the pandemic, because things are changing quickly and may affect the system in many different ways. The challenge is that we have different forces that could affect the loss cost level in different directions. For example, while the overall number of claims may decrease as a result of the economic downturn, premium volume is expected to decrease as well. Will the decrease in premium be the same, greater, or less than the decrease in claims? Similarly, there would be difficulties projecting the impact of the pandemic on the average claim severities. Will claimants stay out of work longer due to the economic conditions? Will injured workers experience difficulty obtaining the necessary medical care? What would be the effect of telemedicine? How would the changing economy and the workforce affect claim frequency and severity? The rating board is continuing to study the effects of the pandemic on the workers' compensation system. And later today, we will have a panel discussion devoted to this very topic. That said, we do have some preliminary statistics on the rapidly changing workers' compensation claim environment, as well as some early information on COVID claims. The source of this information is New York Open Data. First, let's take a look at the percentage difference in claims activity between 2019 and 2020. We see that in January and February, claim activity was relatively similar, with a decrease of about 5% in February. In March, the pandemic really hit New York. In mid-March, Governor Cuomo issued the stay-at-home order, putting New York on pause. This resulted in a significant decrease in claim activity, with March down by 24%. But this was just when New York was on pause for half of the month. April and May were full months with New York on pause. With the New York economy starting to reopen in June and July, the effect on the claim activity is clear. Still down significantly from 2019, but not as much as in April and May. A decrease of 27% in June and 20% in July. In total, over the first half of 2020, claim activity is down about 24%. This is what we know so far. But we also know that there is a lot more that we don't know, such as the effect of the economic changes on workers' compensation premiums. Clearly, there will be some sort of a decrease due to layoffs, furloughs, etc., but it will be several months before we get the full information on premium changes so that the effect of the economic changes on loss costs and underwriting results can be estimated. Next, let's take a look at what we know so far about workers' compensation COVID claims. We start with the total number of known COVID infections. These are confirmed positive cases in New York. Let's narrow that down to the estimated number of COVID infections in people that are between the ages of 18 and 64. As of early August, we're at about 305,000. Now let's look at the number of COVID workers' compensation claims. You can see it in the bottom of your screen. At just over 11,000 as of early August, or just over 3.5% of positive cases in the working age population. While it may appear like a low percentage, there are a variety of reasons for that. According to the Centers for Disease Control and Prevention, about 40% of cases are asymptomatic. And out of the symptomatic cases, only about 3.4% require hospitalization. So the vast majority of cases are either asymptomatic or relatively mild. Also, in order to receive workers' compensation benefits, claimants will have to show that they have contracted COVID at the workplace. And many possibly didn't. And those who may have contracted it at the workplace and do end up missing a limited amount of time from work may rely on other paid leave programs for income security instead of turning to the workers' compensation system for relief, either because they don't want a reduction in pay or they do not want to go through the workers' compensation system. With that in mind, let's discuss other statistics on premiums and losses in New York from the pre-pandemic era. These various statistics are important to understand as they would serve as a benchmark to measure how they changed between the pre- and post-pandemic eras. Premium volume in the state decreased from $5.9 billion in 2018 to $5.6 billion in 2019. This is the first significant decrease in premium volume since 2008. Growth in payroll, as well as increasing loss costs, resulted in significant premium growth from 2010 until 2016, where premiums stabilized. The recent significant decreases in the loss cost level are the primary driver of the decrease in 2019. But we have to remember that there are other factors affecting premium volume in the state, such as deductible credits, which could fluctuate significantly. The growth in premium volume over the past decade has also affected the share of New York workers' compensation premium out of countrywide workers' compensation premium. The percentage of New York premium out of countrywide premium has increased over the past 10 years from 7.6% to 9.7%. Let's talk about classifications. Data is collected by each occupational classification. There are over 550 different occupational classifications in the system. This is a view of the top 10 governing classes in New York in terms of payroll. Not surprisingly, clerical office employees represent the largest class in terms of payroll. It is followed by hospitals, physicians, schools, and clerical service contractors. The top 10 classes by payroll represent 52% of total statewide payroll, but only 17% of the standard premium. This is because some classes, such as the clerical office employees class, have very low loss cost and generate very little premium. In fact, when we rank the classes in terms of premiums, the clerical office employees code doesn't even make it to the top 10. Hospitals generate more premium than any other class. Interestingly, in the top 10, we have 3 classes in terms of premium volume that are from healthcare-related industries. This points to the importance of the healthcare sector in workers' compensation and to the economy in general. Moving on to market share information. The New York State Insurance Fund is a competitive state fund and is not there strictly to serve the residual market, as may be the case in some other jurisdictions. The market share is often viewed as a measure of how competitive the market is. Market shares can be measured in different ways. First, there is the direct written premiums, which are reported on the carrier's annual financial statements. These are the premiums after application of premium discounts, deductible credits, and so on. Based on this measure, in calendar year 2019, the state fund market share is 35.5%, and private carriers are 64.5%. Next, we keep the premium definition as is, but we split the private carriers into two pieces. One piece in pink is regular policies, and the other in purple represents large deductible policies. So all we did here was keep the state fund market share the same, but we split the 64.5% of the private carriers into 54.7% written regular policies and 9.8% written on large deductible policies. Next, we look at the market share based on standard premiums. Standard premiums, as defined here, represents premium before the application of premium discounts and deductible credits, which could be very significant. In other words, focusing on the 9.8% that were written on large deductible policies, if they were written on a standard basis, without those credits, the premium would have been much higher and would actually represent over 37% of the premiums in the state. So on a standard premium basis, that brings the state funds market share down to 27.6%. Finally, we have to remember that so far we're talking about the insured market. According to the National Academy of Social Insurance, workers' comp benefits paid for self-insured claims represent about a third of the entire marketplace. Bringing this into the mix yields a state fund market share of just over 18% out of the entire workers' compensation marketplace. We briefly go back to the direct written premium market shares, and here we observe how the market share has changed over time. And we know that after gradually increasing market share up to a high of 45.1% in 2014, we are observing 5 straight years of decreasing market shares, down to a level of 35.5%, which is the lowest we've seen in quite some time. After the rating board derives the loss costs, carriers then apply their loss cost multipliers, or LCMs, to get their full rates. Here we see that 99 carriers have a loss cost multiplier between 1.3 and 1.4, more than in any other loss cost multiplier range. However, most premium is written with a loss cost multiplier under 1.2. Here we show the premium written by loss cost multiplier range, both on a direct basis in blue and standard basis in yellow. The difference between the bars are primarily attributable to deductible credits, followed by premium discounts and other more minor credits and charges. We observe then that not only most premiums are written with a loss cost multiplier of less than 1.2, but we also see that most deductible credits are applied on the lower loss cost multiplier policies. Now let's examine the distribution of policies by policy size. Most policies in the state, over 400,000 of them, are relatively small policies with premium under $5,000. Despite the large number of these policies, representing more than 75% of all policies in the state, because of their smaller size, they only generate less than 6% of total premium in the state. Larger policies represent a small portion of policies, but a significant portion of premiums. Policies with premiums over $50,000 represent less than 5% of policies, but account for more than 75% of premiums. Policies with premium over $1 million are 0.2% of policies, but more than 30% of premium. Let's shift gears and discuss some loss statistics. We start with claim closure rates. Overall, at first report, which is 18 months from the policy effective date, about 70% of claims are closed. At 10th report, or 9 years later, about 97% of claims are closed. But we have very different pictures when we examine the more minor medical-only claims against lost time claims. Close to 90% of medical-only claims are closed at first report, and almost all of them are closed at 10th report. Lost time claims, on the other hand, remain open much longer, with only 37% closed at first report, and at 10th report, about 8% of lost time claims are still open. Looking at the lost payment pattern, we see that after 10 years, only 73.3% of lost payments have been made, meaning that there are still more than 26% of lost payments remaining to be made on only 8% of the lost time claims. This implies that these claims that remain open after 10 years are the most severe claims and will be paid out over many more years. Examining the distribution of claims and losses by injury type, we observe that although medical-only claims account for almost 60% of claims, they are generally very small claims and represent only 2% of the total loss amounts. Fatal and permanent total claims don't happen often, but they represent almost 6% of losses. Permanent partial claims are the most significant cost driver, accounting for almost 75% of the losses, even though they represent just under 20% of the claims. These are the top 10 parts of body in terms of claim counts on the left and in terms of total losses on the right. It's interesting to note that injuries of certain body parts are clearly more expensive than others. For example, shoulder injuries represent 9.3% of claim counts, but close to 15% of lost dollars. On the other hand, fingers and thumbs represent more than 12% of injuries and just 3% of losses. Injuries to the lower back, knees, and shoulders represent the highest percentage of losses. Next, we're going to look at the distribution of medical costs. And the number over the next several slides are going to be from our medical data call, representing payments made for services performed in 2019. We start with the overall distribution of 2019 medical payments into major medical cost categories. And we observe that physicians represented the largest medical payment category, with almost half the medical payments in 2019, followed by hospitals with 22% and prescription drugs at under 10%. Digging a little deeper into the largest category of physician costs, we see that in 2019, payments for surgical procedures represent just over a quarter of physician payments, followed by physical medicine, which represents an additional 25% of physician costs, and evaluation and management services at 18%. The physical medicine and evaluation and management percentages represent an increase from what we saw in 2018, which may be attributable, at least in part, to the changes in the state's medical fee schedule, which went into effect in April of 2019. The second highest payment category was hospital services. So we would like to examine the breakdown of facility services. Payments for inpatient hospital services were just about half of all facility services. Outpatient payments were just about 28%, and ambulatory surgical centers were 21.1% of facility services payments, which is another year where we see an increase in this category. In fact, when we examine the changes in the percentage of payments for ambulatory surgical centers over the past several years, the trend is clear, with continuous increases from 2.4% of total medical payments in 2011 to 7.9% in 2019. Let's take a closer look at prescription drugs. An examination of drug payments as a percentage of total medical payments shows an increase from 2011 to 2014. At that point, the combination of a nationwide battle against the opioid epidemic, which included the I-Stop legislation in New York, as well as stronger adherence to medical treatment guidelines, may have contributed to the significant decrease in payments for prescription drugs. Taking a closer look at various prescription drug categories, we see that opioids, on top, are still the biggest contributor to drug costs. Several years ago, though, opioids represented over 29% of drug costs. So the opioid share of total prescription drug spend decreased significantly to just under 22% in 2019. So this decrease in the opioid category is clearly a contributor to the overall decrease in the share of prescription drug spend out of total medical spend. Interestingly, NSAIDs are the second highest category and are exhibiting a slight increase since last year, suggesting that providers are replacing opioids with NSAIDs as a treatment for pain. After talking about premiums and losses, where does it all bring us in terms of underwriting results? We're going to start with accident year loss ratios, which are ratios of losses on claims occurring in each year to premiums from these years. And these are the loss ratios by accident year. And they have declined from a high of about 93% in 2010 to just about 54% in accident year 2016, but have since experienced an increase to a level of 64% in accident year 2019. This recent increase is attributed in part to decreasing loss cost levels in the past several years. A combined ratio is the ratio of losses, expenses, and dividends to premium. To get combined ratios, we start with the loss ratios and we add expense ratios and dividend ratios. Generally speaking, as an example, an accident year combined ratio of 90% means that for every dollar of premium earned by a carrier in a particular year, they will pay out 90 cents in losses occurring during that year and expenses incurred during that year. The combined ratio measure does not take investment income into account. Accident year combined ratios have declined from a high of over 140% in 2010 down to the mid-90s earlier in the decade, a significant decrease, which is then followed by a small increase to a level of 99% in accident year 2019. Now, a few words before we turn to calendar year results. First, we have to remember the difference between accident year results and calendar year results. While accident year results relate to financial outcomes associated with claims occurring in the respective year, calendar year results relate to financial outcomes associated with transactions occurring in a given year. For example, if a payment is made in 2019 on a claim that occurred in 2010, that payment is part of accident year 2010 results and calendar year 2019 results. Also, here's a quick reminder on loss development factors. Recall how I explained earlier in the context of the loss cost filing that these have been decreasing significantly over the past several years. The lower development factors contribute to a lower estimate of ultimate losses this year than last year. We're going to stick with accident year results for just one more minute. As an example, let's take a look at accident year 2015. We start with the loss ratio as was estimated last year based on data as of year-end 2018, 64.5%. Now, this year, because of the lower development factors and lower reported loss amounts, our estimate of the ultimate loss ratio for the same year, accident year 2015, as of year-end 2019, is 59.7%, a decrease of 4.8%. When we look at how other accident year loss ratios changed during calendar year 2019, the picture is clear. So all this reduction in loss ratios for all these previous accident years is happening due to transactions, mainly reserve changes, that are occurring during calendar year 2019. And when we look at calendar year loss ratios, it should be no surprise that the resulting loss ratio for calendar year 2019 is now at a historic low, under 47%. This 46.9% figure is the result of the takedown of reserves on previous accident years. Calendar year loss ratios have decreased from a high of 96.4% in 2010 to a low of 46.9% in 2019. To determine the combined ratios, we again start with the loss ratios in blue, and we add on the expense ratios and dividend ratios. The resulting 2019 combined ratio is 81.8%. We have to remember, though, that this is just a snapshot of financial results based on transactions occurring during the specific calendar year, which may include payments and reserve changes on claims that occurred years ago. It is not a measure of whether premiums were too high or too low, because the premiums and losses used in the calculation do not come from the same group of policies. It is also important to remember that this is a snapshot of a single year, but should not be relied on to measure long-term profitability, especially in workers' compensation, which is a very long tail line. A better measure, but still not a perfect measure of longer-term profitability, may be a longer-term average of calendar year combined ratios. Over a 10-year period, from 2000 to 2009, the average combined ratio was 116. Moving 5 years forward, the 10-year average from 2005 to 2014 has decreased to 109. And moving another 5 years forward, even when including the very low combined ratios of the most recent years, the 10-year average combined ratio is 104. The point is that a single calendar year combined ratio may be of interest to company shareholders and investors, but should not necessarily be relied on to measure longer-term profitability. I hope you enjoyed the 2020 State of the System presentation. Once again, the Rating Board is committed to continue monitoring and reporting on the workers' compensation system. As things change very quickly, I am hopeful that the information I provided here will be useful for all industry stakeholders and will serve as the benchmark for future comparisons of various statistics between the pre- and post-pandemic workers' compensation environments. Back to you, Jeremy.
Thank you, Ziv. I hope that you found the 2020 State of the System presentation insightful. If you'd like to review the information that you just heard, you can view the print version of the 2020 State of the System report on our website, www.nycirb.org. Next up is the Rating Board's Director of Actuarial Research, Brett King. Brett will present the 2020 frequency study. You're up, Brett.
All right. Thank you, Jeremy, for that introduction. Now, on to the frequency study, where we will examine the frequency of claims and the impact of various system forces on frequency. So what is frequency? Let's first take a look and discuss the definition of frequency to gain a better understanding of this measure. Frequency is usually defined as the number of ultimate lost time claims expected per $1 million of wage-adjusted, unleveled loss costs, or, in other words, standard premium brought to the current wage and loss cost level. Let's try to unpack this definition and discuss each of the components in a little more detail so we can understand some of the interacting forces in the workers' compensation system. Here is frequency defined using a formulaic approach. Here, we can see that frequency is equal to the ultimate lost time claim count, which would involve taking the current number of claims and developing that claim count to an ultimate basis, divided by the wage-adjusted payroll for each class that would put wages on the current levels, divided by 100 because we use payroll divided by 100 as the exposure base, times the loss cost, which is also at the current level and not the historical one, to adjust for the benefit and other system changes in the base over time. This denominator, which is equivalent to the standard premium at wage-adjusted and unleveled loss costs, is measured per $1 million to give us a consistent denominator as the base for comparison purposes. Although this seems like quite a straightforward formula, I think there are some complicated relationships that are going on. We will discuss some of these relationships in the next couple of slides, as I hope to help you understand the concept of frequency more broadly, since that would lead to a better understanding of the reasons behind frequency changes over time. The workers' comp system is continually changing, and many of those changes can impact frequency. There are reform changes that happen from time to time, and these changes can affect things like fee schedules and benefit structures. They can affect prescription drug usage patterns, and they can happen at any time, from one year to the next. They tend to happen every few years. They're not necessarily that frequent, but when they do happen, they can have a large impact on the systems and can sometimes noticeably change frequency. There are also economic changes that are continually occurring. Sometimes the economy is expanding, and sometimes it's contracting. Right now, during the epidemic, we know that there has been a large economic contraction, and that is going to have a major impact on the system. We also know that there are inflationary forces that impact the system. We have wage inflation and we have claims cost inflation, like that for medical costs over time. We also have a continual push for safety, so that workplaces should become safer and safer every day as we learn to prevent injuries from happening. Finally, we also know that there are changes in medical treatment options. Sometimes there are new technologies that become available to treat injured workers, and sometimes we realize that something like opioids, for instance, are more dangerous to the injured workers than at first was realized, and therefore there's a change in their usage. All these forces are continually interacting with one another, causing the system to change. Some of these patterns are somewhat predictable, whereas others are not. Today, we're going to start by looking at some average annual changes to understand the long-term patterns that are slightly more predictable. We studied policy years 1987 to 2018, and what I'm going to show you here are average annual changes. So in a typical year, this is what you might expect to see. But of course, there can be much variation around these numbers. On average, premiums would increase 4.2% per year. Now, these are system premiums. It's not an individual company's change in rate or anything like that, because premium is influenced by a variety of things. For example, premiums can be affected by economic growth as the economy expands, or by several other components. The first of those components are payrolls. Payrolls generally increase year over year as part of the inflationary environment we live in. And so we see payrolls increase 4.2% per year as well. These payroll increases could be due to either economic expansion or regular payroll increases that are part of the inflationary forces in our society. Premiums are payrolls divided by 100 that are then multiplied by a loss cost, which is the second major component that can affect premiums. Loss costs increase about 2% per year over the years from 1987 to 2018. However, most of this increase was caused by multiple double-digit increases in annual changes back in the late 80s and early 90s. If we calculated an average loss cost change starting in 1995, the result would have been an average annual decrease of 1.7% per year. During the study period from 1987 to 2018, we also see an increase in claim severity of about 3.7% per year. This captures the increasing claim costs due to increasing wage benefits and medical inflation. This is counterbalanced by a decrease of about 1.6% per year in the number of claims we see in the system. This is strictly a claim count and not frequency. We're going to talk more about these items and how they interact as we go through today's presentation. Before we start talking about how frequency and severity may interact together in detail, let's start by looking at the raw components of the frequency measure to gain a better understanding. Here in this graph, we start with the developed claim counts, which are represented by this blue line, and the scale on the left-hand side representing the number of lost time claims. Here, you'll notice that the number of claims were quite stable back in the late 80s and early 90s. However, starting in the mid-90s, from about 1995 all the way to 2006, we see a decrease year over year in the number of lost time claims in the system. Once we hit 2007 to 2010, we see some stability again before the claim counts start to rise between 2011 and 2018. Some of this rise is due to expansion of the economy after we came out of the Great Recession. We will also talk about this a little more later, along with how it relates to the frequency metric a little more on the next slide as we put the pieces together to show you the overall frequency changes over time. But now, we bring in this red line. This red line represents the actual standard premiums by policy year that were collected in the system, using the scale on the right. These premiums are not on the current level, and they have not been adjusted for wage changes that have happened over time since these policies were written. For example, somebody in 1987 would have made about 3 times more in today's dollars than they did back then, due to wage inflation over 30 years. You will notice this line is quite like a roller coaster, with pieces that are up sharply as well as down sharply, as loss costs or rates have changed over time. When we adjust this historical standard premium for those on-level changes, we adjust to both the current wage level and the current loss cost level to make them reflect the system in its current state. Once we make those adjustments, you can see that the line changes from this roller coaster up and down red line to a smoother light blue line with generally less transition from year to year. There are still some changes, and in particular, I want you to focus on the standard premiums from the late 80s and early 90s. I want to talk about that for just a little bit. In the late 80s and early 90s, there was a lot of double-digit rate changes and large wage level increases. It was a rate change back then, and payroll changes were quite large. The wages for somebody today would be over 3 times greater than they were 30 years ago, which is about the time difference we see here. Although I was in high school and college during the late 80s and early 90s, I do remember some of the crazy things that were going on back then, like social inflation and the savings and loan crisis. We will discuss these items more, but first, let's put the pieces together and look at the frequency graph. The blue line on this graph is the policy year loss time frequency level. We see that between 1987 and 1996, there was generally an increase in claim frequency. This increase in frequency is really caused more by the premium piece because of the large increase in rate and payroll adjustments during this time, rather than a change in claim counts. Back in the late 80s and early 90s, wage changes of 8 or 9% were not that uncommon, whereas today we often see wage changes closer to 2 or 3% every year. Also, remember we had a double-digit rate increases during these older years. Starting in 1997 through around 2007, we see a frequency decrease, and then in 2008 forward, we generally see a much more stable environment. The shaded bars we've added on this graph represent recessionary periods. In the late 80s and early 90s, there was a savings and loan crisis that affected many banking institutions and was a major contributor to the earliest recessionary period shown here. Around the turn of the millennia, there was the dot-com bust, which also contributed to another recessionary period. It was followed by a housing bubble and bust in the mid-2000s that later led to the financial troubles that caused the Great Recession in the 2008 to 2009 timeframe. The recovery from the Great Recession took many years, and this explains partly why claim counts were increasing slowly on the last slide as the economy rebounded very slowly from 2010 all the way through 2018. Typically, when a recession happens, frequency drops. Although this was not the case in 1989, we do see frequency drops in 2001 and 2008. I'm expecting a similar drop from COVID-19 as we see the economy contracting. However, because frequency is a ratio dependent on both payrolls and claim counts, we can't be sure until we see all the data. So, one of the takeaways from this slide is that economic changes can have an impact on frequency. Typically, when we experience a slowdown in the economy, we also see a drop in the frequency of claims. Now we will talk a little bit more about the interaction between frequency, severity, and reforms. Here we have the same frequency graph that we showed you before in blue. We are also going to add the severity graphs for indemnity severity with a line color of purple, and this medical severity you will see later in yellow. First, as we look at the purple line for indemnity severity, we see that it was generally stable prior to 1996. but that it increased sharply between 1997 and 2007. After 2007, it again stabilized, although the most recent 2 years show an increase. As we bring in the yellow line for the medical severity, we see that this line is also very stable prior to 1996. It increases between 1997 and then is stable again after 2007, all the way through 2018. This is generally the same pattern we saw above for the indemnity severity. Although these patterns are often the same, they won't always be identical. We also see that the purple line is above the yellow line because the indemnity costs are greater than the medical costs in New York. This is a little bit different from other states where medical spend can sometimes be the larger cost component. We also have added 2 vertical lines here in green for major reform changes. Now, there was a major reform change in 1996, and there was another major reform in 2007. If we look using these dividers, we dramatically see different patterns in our frequency and severity before and after the reforms in each of these cases. In the late 1980s and early 90s, we saw an increase in frequency with stable severity, and this was driven by a lot of the increases in payroll and rate changes. Frequency then began to decrease after the reform in 1996. But as we started to see an increase in severity as well at the same time, those offsetting trends are quite common because of the nature of the standard premium base in the frequency measure and the relationship to loss costs that frequency and severity each contribute to. To talk in a little more detail, the total system costs per $1 million of losses are a combination of the number of claims and the average severity of those claims. So, if we see the average severity of claims increasing, then generally we will see the number of claims decreasing per $1 million of expected loss or standard premiums. If this increase in severity grows more steeply, then the number of claims would often decrease more steeply per $1 million of expected losses or standard premiums as well. Of course, it's possible for both items to stay the same, or even for the frequency of claims to increase. However, when we see the frequency of claims increase, we will often see the severity decrease. This is because of the relationship that frequency and severity share in determining the total losses per $1 million of loss cost premium. In 2007, we had another reform, and that reform has made the environment much more stable. Since 2007, both frequency and severity graphs have become much flatter, and the trend environment has been much more stable. This could also be related to the low interest and low inflation environment we have generally seen since the Great Recession. Let's start to break down these years from 2000 to 2017 in more detail and look a little bit deeper beneath the surface regarding what is going on. Here on this slide, we are going to look at some average annual changes in premium share, payroll share, frequency, and severity by industry. And we're going to compare the average industry group frequency level to the overall frequency level in total. Let's start by looking at the numbers on the far right, which reflect the relative frequency of each industry group relative to the average frequency level overall. You will notice that only the contracting group at the bottom of the list has a frequency level below average. That is represented here by a negative 45.2%, meaning that the frequency of injuries in this industry group is almost half the average frequency. All the other industry groups have slightly higher than average frequency, as can be seen by the positive values. However, there's also an ordering amongst them that we can see here, since this column is sorted from the highest relative frequency to the lowest. The stores and dealers have the highest frequency level, that is 32.6% above the average frequency level. This is followed by the professional, manufacturing, and service industry groups, which are close together in terms of frequency. The miscellaneous industry group has a close to average frequency, as a 0% number on this chart would represent average frequency, and the miscellaneous industry group is only 3.3% higher than the average industry level. Next, we bring in the column on the left, which represents the average premium share changes between the industry groups from year to year. Since premium is partially related to payroll, we will bring in those payroll share numbers as well. One of the big stories here that is shown by focusing on the red highlighting is the shift away from manufacturing towards other industry groups. We can see that on average, manufacturing has declined between 2 to 3% per year over the study period. This is not a new phenomenon for New York. This is also a countrywide pattern. Sometimes this is because of increased automation, and sometimes the jobs may be going other places. But regardless of why, there has been a general shift of payroll and premiums away from the manufacturing sector. What is happening is that the market share of manufacturing is being replaced by industries with a lower relative frequency for the services, miscellaneous, and contracting industry groups that we see, highlighted here using green text. This places negative pressure on the frequency metric. You can see this by examining the values highlighted in green and noting that the manufacturing had a relative frequency 16.4% higher than average and a decreasing market share, while the other green-coded values show an increase in premium market share on the left and relative frequencies on the right below the 16.4% level of manufacturing. This shifting of the premium between manufacturing and other industry groups with lower relative frequency places downward pressure on the frequency metric. Another area of growth that replaces some of the manufacturing share is in the professional industry. Let's bring in the last two missing columns that show these important frequency and severity changes and examine how the growth in the professional industry group also places downward pressure on the frequency metric and changes from year to year. What is interesting about the professional industry is that it has a larger than average annual decrease in frequency when compared to other industries. Here, we see the growth in premium share for the professional group highlighted in blue on the left, while simultaneously seeing a larger decline in average frequency changes in the professional industry group than other industries, now highlighted as well. This negative 3.3% average decline in frequency is the largest decrease seen by any industry group, and it is coupled with a smaller increase in severity than any other industry group. Growth in the professional industry group that had the largest year-over-year declines in frequency also places downward pressure on the frequency metrics year-over-year changes. Let's next look at how those changes are affecting the distribution of claims. So here on this slide, we are looking at how the mix of claims by size of claim is changing underneath the surface. Here, I want to point out to you the two red lines. These two red lines represent claims between $5,000 and $25,000. As you can see, these two lines are decreasing at a faster rate than the other lines you see on this graph. If you look at the two green lines, these represent larger claims between $25,000 and $100,000. We see that these claims are decreasing at a much slower rate, and so we observe that smaller claims are leaving the system faster than larger claims. On average, the other blue lines have less of an impact because they are either changing slowly or the numbers of claims is not that numerous when compared to the other categories. The purple line represents claims over $100,000 that one would expect to be a driver of industry cost. These go up and down with the economy. The dip that we see in these claims from 2004 and 2012 are a result of the economic slowdown during this time related to the bursting housing bubble and the Great Recession, and are more related to a move away from contracting during this time, followed by a slow economic expansion in the contracting industry as the economy itself recovered very slowly over time. On this next slide, we're going to look at the common injury types. On the left-hand side, we show average annual changes for frequency and severity by injury type. On the right-hand side, we also show frequency and severity changes by injury type, but on a cumulative basis over the years from 2000 to 2017. You can see how the annual changes can add up over time, but I'll focus today on the annual changes. At first report, what we see is that there has been less change in permanent partial claim frequency than there has been to temporary total and medical only claim frequencies. Note, we are including medical only claims here only for comparison, as they support the general pattern we see in lost time claims too. When we examine frequency in the darker blue, we see that the permanent partial frequency of claims is down only 2.2% per year. The temporary total claims and the medical only claims, which are generally smaller, are down by 2.4% and 3.7% respectively. So again, we see the smallest claims disappearing faster than the larger claims. We also see that the permanent partial claim severities in the lighter blue are increasing the fastest, with almost a 4-point average annual increase in severity. Temporary total and medical only claims are also growing, but not quite as fast. They are growing at 3.3% and 3.2% respectively. So we see in the system that the smaller claims are disappearing faster and growing slower in size than the larger claims, which are disappearing, but just not as quickly. We also see the larger claims are growing considerably more in size year over year. Let's drill down into the lost time claims even further by examining the injury characteristics of these claims. We usually have several different descriptors on each claim to track different types of injuries. One of them is the part of body. Another is the nature of the injury. And finally, we have the cause of injury here on this slide. We have looked at what is changing based on these part, nature, and cause injury mixes. First, we notice that the frequency of lower back claims is decreasing more than average, and that is a good thing because these claims can sometimes become more expensive than you would otherwise expect. Also, we see injuries to the shoulder, arm, neck, and head are decreasing less than average. This is unfortunate, and we need to see what is causing that. I'll explain later that injuries to the shoulder, arm, neck, and head are affected by the age of the injured worker, and that the results we see here could be related to the aging of the workforce. We also have nature of injury, and here we notice that fracture, crushing, and dislocation injuries are decreasing less than average. That is because these types of injuries are generally quite rare and not very plannable for. No one is looking to fall over and fracture their leg or get crushed by a piece of machinery. That is why I think these types of injuries are harder to control for. Finally, we looked at cause of injuries. A good thing here is that we are seeing strains and miscellaneous causes having larger decreases than average. And so we're able to prevent some of these injuries, perhaps by using braces or just proper lifting techniques, and that's a good thing. Unfortunately, slip, trip, and motor vehicle accidents are not decreasing as much as other causes of injuries, and that is again because of the nature of these accidents, and there's not much you can do to prevent some accidents in some cases. Let's now go back to the subject of age and examine how that relates to the injured part of body. On the left-hand side here, we have some injuries where I think age is showing a larger impact on frequency. On the left, we see shoulder, arm, knee, leg, and neck injuries, as well as multiple body parts and other injuries. We can see that younger workers typically have less of these injuries than older workers, and so age is a key component of these injuries. Age-related weaknesses or cumulative trauma injuries could contribute to this observation. However, on the graph on the right, we see less of an impact based on age. The lower back area may have a slight increase in frequency based on age, but the magnitude is smaller than those on the left-hand side graphs. However, the hand, wrist, ankle, foot, toe, and head injuries are more uniform across all of the ages. So we notice that age impacts the frequency of some injuries differently than others, and this explains that there is likely going to be a different injury mix as the workforce ages. Here we are looking at age again, but we are also looking at industry group, and we have noticed some unique things when we do this. First, I want to point out that the manufacturing, professional, and services industry groups all had very similar patterns, and so we've combined them here in this blue line. This is kind of what you would normally expect with frequency overall, And that is why, when we have looked at the relative frequency slide near the start of this presentation, these all had a similar relative frequency. If you remember that slide, the industry group that stood out the most is contracting. The contracting group, which we see here in orange, has a much lower frequency than the other industry groups, but there is going to be a much higher severity for these claims too. They have a very different mix of claims than other industries, with a higher average severity, and that is important to remember. Another industry group that stands out for a different reason is the stores and dealers industry group. Looking at the stores and dealers, which is a gray line, we see the younger workers actually have a pretty high frequency relative to other industry groups, but it still has a spike for those in their mid-40s into their 50s. This increase in frequency could be caused by several different factors, such as the age mix of the industry or the work that younger versus older workers may do in this industry group, along with their experience level and safety consciousness. I cannot clearly opine as to why this industry group is different, only that it is. Similarly, the miscellaneous group looks a little different as well. Here in yellow, we see the line for the miscellaneous industry group. It starts a little higher than the blue line group for most people who are younger, but it's the people in their early 40s that seem to have the highest frequency of claims for this group. Again, it's a little harder to explain why, as the miscellaneous industry group itself is a collection of classes that do not fit neatly into another industry group. One last thing that we looked at in our frequency study was the difference for large losses by industry group, by age, and by report. In this graph, we study the frequency differences of large losses. For these purposes, we're going to call claims over $100,000 large claims. As we look at them by industry group and report, one thing that we notice at first report is that contracting classes often have these large claims that appear first. And so we can see on the graph on the left that the orange line is above the other lines for workers between the ages of 24 and 52. This is a consistent thing that we've seen before. We've noticed larger losses generally appear faster in the contracting classes. However, if we move 5 years forward and look at the same losses 5 years later at the fifth report, then we see that most of the other industry groups actually surpass the contracting group in terms of the frequency of these claims. This is a pattern that will continue because the large claims for contracting will appear or are known about faster than other industry groups, because people in the professional and services industries, for example, may get injured, and it may be a long time before we realize the severity of their injury, and they get recognized as large claims later in the process. In summary, I'd like to remind everybody about the relationships between the ultimate claim counts we see in the numerator of the frequency calculation and the values of payrolls at current level, the current loss cost levels, and claim severities that are all interacting in the standard premium determinations that impact the denominator of the frequency measure. These elements have an impact on the frequency, along with reform changes, other economic or system changes, whether the economy is expanding or shrinking, and how the mix of business is changing. There are other inflationary forces at work that interact with indemnity or medical losses differently. And of course, there's always a push for safety. Frequency can also be impacted by the age of the worker and the industry group in which they work, as well as the mix of injuries that are being reduced more quickly, which has typically resulted in removing the smaller claims from the system at a faster rate than the larger claims. There is also a changing set of medical treatment options based on what the medical community and researchers determine is the best course of action for our injured workers. I hope you found this presentation educational, and if you have any questions or ideas for further research, please feel free to reach out to me to discuss them. Thank you for your attention. And now, back to you, Jeremy.
Thank you, Brett. The full 2020 frequency study, which provides key takeaways, a full analysis, as well as data sources, is available for viewing and download on our website. Now on to our panel discussion on the COVID-19 pandemic. The moderator of today's panel is the Rating Board's Director of Actuarial Production, Gua Harrison. Gua, the floor is yours.
Thanks, Jeremy. Welcome to today's panel discussion. The topic of today's conversation is one that has impacted every American, the COVID-19 pandemic. We will explore the pandemic's impact on the New York State workers' compensation system and the future of the workplace generally. We're very fortunate to have several accomplished panelists to join us today to help us sort through it all. I'm certain that many of you know them. Let me introduce our first panelist, who has extensive medical background, Dr. Joseph Pachman. Dr. Pachman served as the National Medical Director of Workers' Compensation in Managed Care at Liberty Mutual, where he has worked for over 12 years. He's also a member of the New York Medical Advisory Committee on Medical Treatment Procedures. Dr. Pachman is a licensed physician as well as a licensed psychologist. He's also directed 2 hospital-based occupational medicine clinics as well as international travel clinics. He holds an MD from UConn and has a master's in public health and epidemiology from Yale Medical School. Dr. Pachman is a fellow of the American College of Occupational and Environmental Medicine. Our next panelist is the General Counsel of New York State Workers' Compensation Board, David Wertheim. David has been with the board for 23 years, working in various roles in adjudication and appeals. He was appointed to serve as General Counsel in 2016. David has been instrumental and played a key role in several pragmatic and legislative initiatives, including the Virtual Hearing Center, which has continued unabated during the COVID-19 pandemic, the 2017 enactment of paid family law, the 2017 enactment of paid family leave, the workers' compensation reform in 2017, and the expanded provider law in 2019. Our third panelist is Robert Gray. Robert is a managing partner at Gray & Gray, a law firm that specializes in representing injured workers in workers' compensation, Social Security disability, long-term disability, personal injury, and related matters. Robert has represented thousands of clients before the Workers' Compensation Board, as well as at trial in personal injury cases in state and federal court. Our fourth panelist, Howard Levin, specializes in labor and employment law. Howard is a partner at Struck & Levin and serves as counsel for a diverse group of clients across various industries, including insurance, entertainment, healthcare, finance, and manufacturing. Now, lastly, we have Ben Witkowski from the Rating Board. Ben is the Director of Special Projects and Actuarial Products. Prior to joining the Rating Board, Ben worked 14 years for the Hartford, working in various roles such as Director and Actuary for Workers' Compensation Reserving and Claims Analytics. Ben is also a fellow of the Casualty Actuarial Society. As I mentioned a few moments ago, the focus of today's discussion is a topic that we have all been living through and thinking about for the past 6 months. The COVID-19 pandemic. The pandemic brings significant uncertainty, and the challenges we face in New York are unique. The downstate metropolitan region, New York City, is the most densely populated American city with approximately 27,000 people per square mile, and the density and the way of living that results presents a myriad of complexities for residents, businesses, workers, first responders, schools, and public generally. Now, with an uncertain future and a past that offers only limited guidance, we look and listen to our experts to gain a better understanding of the current issues and what the future may hold. Now, let's start from the beginning. The COVID-19 pandemic began in New York in March of 2020. David, how did Workers' Compensation Board respond and adjust initially?
Well, thank you, Gua, and I'd just like to say thank you for inviting me to be on a panel with my fellow very distinguished panelists. Like everyone else, the board had significant logistical challenges to deal with in terms of making sure that if we needed everybody to be home, could everyone work? How would they work? How would we handle everything from the mail and printing to making sure our scanning vendor was operational? How to handle phone calls, dealings with the public, and most acutely, hearings. Could we continue holding them? Could we have a monthly board meeting, etc.? On top of that, we had to consider many legal and operational challenges to the system of compensation and coordinate both the injured worker side and the administrator and payer side. And on top of that, there was the question of COVID-19 itself as a matter of workers' comp, which I know we're going to get into today. So the main things the board did were in the form of guidance, and the major ones were in place by the end of March. For example, the continuity of hearings by remote-only attendance via our virtual hearing center, coupling this with enabling a mix of our law judges to conduct hearings from home, as well as our district offices. And remote-only hearings keeps everyone safe, but also technologically not having to operate through the district office, since no one's there, enables our judges to conduct hearings from home during this emergency. We didn't skip a beat. There have been no COVID-related delays. The way we like to think of it is that we built Noah's Ark in advance, and we've hopped onto it when COVID happened. We gave guidance on the continuity of receiving prompt medical care through the promulgation of emergency telemedicine regulations by emergency rulemaking, as well as stating an intent to dispense with the 90-day requirement for ongoing temporary disability in the event that somebody was having difficulty being able to see their doctor because of the pandemic. We provided guidance on things like extensions for IMEs, depositions, appeals, and compliance penalties. And due to the economic conditions, which we're still facing, we issued guidance on labor market attachment, i.e. that where a claimant otherwise has a present tense legal obligation to seek work, that as a matter of evidence, it doesn't make any sense to not excuse that during the emergency. And so we did. And we also stated that, we'd review conditions over time once the emergency is over. We provided relief from the original wet signature requirements for 28 board forms. Our chair sent a letter to all payers encouraging them to be as responsive as possible and as helpful as possible on claims and potential claims. We issued guidance on the cancellation of policies that had been in effect because of Executive Order 202.13, which as of August 6th is now no longer in effect. And in June, our medical director issued a bulletin related to COVID, the medical impacts of COVID. And then in June, we also issued a document relating to compensability. And that's, I know I went through it very fast, but that's basically just a list of how we initially reacted.
Yeah. Thanks, David. It sounds like, it was a challenging time for your organization. And I'm sure for, most of the organizations in New York City particularly, is a lot to sort through starting in March. So now let's turn to compensability. There are a variety of different types of workers who have undoubtedly filed claims, ranging from those on the front lines providing healthcare and selling groceries to construction workers and office workers. Most workers will never be able to pinpoint the moment of exposure or the method of the COVID-19 exposure. What standard has the Workers' Compensation Board applied to determine which claims are compensable? David.
Okay, I'll take this first, but I have to put on my OGC caveat hat for a moment. This isn't guidance. Each case stands on its own merits. And of course, our law judges are independent. There are courts. There are extremely skilled lawyers on every side of the issue, including Mr. Gray. So I'm not looking to say everything I'm saying, represents the, absolute truth on everything, but just to give a sense of how I see these cases being adjudicated, I think it coalesces to a few key points. There are three really important cases that I'm going to discuss very, very, very briefly. I'll lead with the bottom line, though. If you can show that you work in a place with known infections in that environment, you have an opportunity to make that showing. There are a couple of key cases that give us a sound basis to find such a claim compensable. There's one case that goes the other way, which is really different and I think can be distinguished. But again, an extremely basic summary is there's a couple of different branches that apply here in infectious disease cases and environmental exposure cases. And the key concepts include time definiteness of the impacts or exposures that happen in space and time, and also whether the conditions are unusual, whether you want to call it abnormal, extraordinary, catastrophic, whatever word you want to use. On the infectious disease side, the key case, I think, is a Court of Appeals case called Middleton, which involved a corrections officer who was exposed to a coughing inmate who had tuberculosis over a length of time, and then he too developed tuberculosis. That case emphasized the time definiteness requirement, and the court said it could be met by looking at the result of exposure, not just the exact moment of exposure, which, as you said in the intro to the question, is likely not ever going to be known. In that case, as with COVID, if there's a showing that the circumstances likely provided the method and means of transmission, it can be compensable. And the court emphasized the fact-finding authority of their tribunal in this exercise, which of course is the board. One other case to mention, because the Middleton court relied on it in part, and because also I think the facts are very similar to what we see in COVID cases, is a case called McDonough, which is an appellate division case from 1961, where the court found that a claimant was subjected to an abnormal condition, which was an epidemic, and that condition was of sufficient gravity to constitute an accidental injury. The claimant there was exposed to an unusual amount of germs during a specified time while she was teaching young children, and the medical testimony assigned the result of that close contact to the pupils in her classroom, several of whom, somewhere around 10 of them, had contracted a disease, and accordingly the claim was established for an accidental injury. There are contrary cases, and certainly the most important one, I think, and I definitely want to hear what Rob thinks of this as well, is the Albrecht case, which is a case involving a professor who was on sabbatical in Africa who came down with polio while on sabbatical. And in that case, which is an appellate division case, not a Court of Appeals case, the court disallowed an infectious disease claim on the grounds that it didn't meet time definiteness, i.e. they didn't show an exposure at a specific point in space and time. And that court basically held that the Middleton case shouldn't be viewed as excusing the obligation to meet time definiteness. Or if you want to put it another way, the Albrecht court held that there can't be like a but-for causation, i.e., but for being in Africa, he wouldn't have had polio. So they suggest you need more than that. Now, that was a 1978 case following the 1975 Middleton case. So the question would then be, and I think the question will eventually be for a court, does Albrecht mean that you need a singular specification of place and time in order to satisfy time definiteness? Which I don't think you can answer until talking about the other key branch of cases, which is environmental exposure. And the key case there is a Court of Appeals case from 1994 called Johannesson. Claimant there was an office worker for the city of New York, was exposed to lots of secondhand smoke, which led to very acute respiratory episodes. The court there held that environmental toxins, in this case, secondhand smoke, are work-related hazards, even though smoking, just like coughing, which was a big issue in another case, is otherwise an everyday occurrence. It's extraordinary, though, the court said, because exposure to high level of toxins are not part of the ordinary job performance of the person, in this case, the office worker, and where they're dangerous and unavoidable, which they were there in that environment, in which they are in COVID cases, they're compensable. This is an accident case, not an occupational disease case, because there was no distinctive feature of her employment in that case, but there was an extraordinary environmental condition. And when you have that, be it secondhand smoke or a highly prevalent danger like COVID-19, it could be compensable. So my very rough reading of this line of cases supports the idea that of prevalence being important, i.e. you evaluate the evidence of the nature and the extent of the work activities, which must include significant contact with the public or coworkers in an area where COVID is prevalent. And public-facing workers, certainly workers in a highly prevalent COVID environment, like the ones you listed, are workers who can show exposure was at such a level of elevated risk that it constitutes an extraordinary event, even though, again, like you said, and like is true, they're never going to be able to point to how exactly they got it. And I'll just point out, I don't think this means there are no defenses regarding community spread. So, perhaps the evidence will show the person did not work routinely with the public, did not work in an environment where it was prevalent, or was working from home the vast majority of the time. But I do think that Middleton and Johannesson provide the legal framework, and that's the framework from which the board will be operating and reviewing the cases.
Well, thank you, David, for giving us all the references and the court cases. So Robert, David mentioned your name, so now I'm turning it over to you. So what are the biggest challenges in meeting the standard that David just described? And what evidence should claimants put forward?
Thanks, Gua. The answer to that question, I think, really depends on whether the case is being advanced under an accident theory or an occupational disease theory. And I don't want to get ahead of ourselves because I know we're going to get into that distinction a little bit later. I think what David was driving at with regard to accident claims is that there are two different kinds of accident claims that a worker can advance under the statute. One is sort of the garden variety accident claim that we're all familiar with. Somebody lifts something and injures their back, or they trip and fall and they break their arm, and we all understand that there's a time-definite acute event that's an accident. You can have that sort of accident claim for a COVID exposure. The worker could come in and say, I had an acute exposure on this particular day at this time to this person, and I know that this person was positive or they appeared to have all the symptoms, and I'm claiming that my illness was a result of that acute exposure. In general, for an accident claim, the worker's got to prove three things. They've got to show that they were working, they've got to show that they were exposed, and they have to show that there's a relationship between the work exposure and their illness. So, one of the cases David alluded to was the Middleton case on tuberculosis, and there are actually a fair number of tuberculosis cases from a certain point in history. And generally, the way those cases boil down is you have a worker and someone else, either a coworker or an inmate or a patient or whoever, and the worker was in close contact with the infected person for some period of time. The worker develops tuberculosis, files workers' compensation on the theory that it was that work exposure to that specific person over that specific period of time that was the cause of their problem. And the employer's defense to that usually is, well, even if we acknowledge that you had that exposure at work, you could have been exposed someplace else at the point in history where tuberculosis was a more commonplace illness than it was. And the courts have generally held that proof of the work-related exposure and a medical opinion that the illness was likely related to that work-related exposure is sufficient. So to boil all that down, for the acute exposure claim, the worker's going to want to be able to describe the date that they were exposed, the time, where, what symptoms they exposed, what symptoms they observed in the person who they believed was infected. It's obviously going to be impossible in almost every case for the worker to prove to a certainty that this person was COVID positive because of HIPAA requirements. The duration of their exposure is going to be relevant. The time lapse between when they were exposed and when they fell ill is going to be relevant because of the medical science about the onset of COVID symptoms after exposure. And of course, if the worker can point out that they don't have any other documented exposures that they're aware of, that would be significant. So if they live in a house with other people and nobody else in the house was sick before they were sick, that would be a relevant point. As David points out, if it turns out that other people in the household were sick before the injured worker fell ill, that might provide a defense for the employer because they may be able to point to an alternate exposure. The other type of accident claim that a worker can advance, though, is a repetitive trauma case. And that there are a line of cases on that, and Johannesson, I think, even though it's an environmental exposure case, really provides the foundation for it. In my view, David Albrecht was incorrectly decided to begin with, and even if we want to acknowledge that it was a correctly decided case, it's been fundamentally overruled by the rules that were set out in Johannesson. For a repetitive trauma kind of case, the person's going to have to identify the kind of job that they do, how many people they come into contact with per hour, per shift, per week, whatever it is. The time frame in which they were performing that job, I think, is relevant. So if someone was performing a job that they come into contact with members of the public in March and April or May when there were skyrocketing cases, we would assume that there's a greater likelihood that they were exposed during that period of time. If they can document or identify any specific exposures that they may have had in the course of their work duties, that would be helpful. If they can say that there was somebody in their place of employment who appeared to have a fever and was coughing or sneezing, etc., and how many occasions that occurred, that would be useful. Again, when their symptoms began will be relevant as compared to when their work-related exposure occurred. And again, whether there are any non-work exposures would be relevant. So the types of workers who we might be talking about for these repetitive trauma or repetitive exposure kind of cases would be grocery store workers or transit workers, Uber drivers or taxi drivers who were driving people around during the pandemic. It's fair to assume that these people had high degree of exposure in the course of their work during that period of time, and that even if they can't pinpoint a specific exposure, it seems likely that they had work-related exposure. By contrast, if the person's a healthcare worker, that wouldn't be an accident claim, that would be an occupational disease claim, and there'd be a different standard of proof there, which I think we're going to talk about a little bit later on, and I think David and I may have slightly different opinions on sort of a lawyerly difference. But my view is that if the person is a healthcare worker and they're making the claim as an occupational disease, the hallmark of an occupational disease is that the disease is associated with the kind of work that they do. So the law essentially presumes that if something is an occupational disease for that occupation, if you're in that occupation and you have that disease, then there's a causal connection, and that reduces the burden of proof for the worker. I don't think in those circumstances the worker needs to document the specific exposure if they were a doctor or a nurse and they were in a facility where COVID was present. If the employer's defense is that there was no COVID, there were no COVID cases present in that facility, the employer may defeat that case on an occupational disease basis. I think the last thing I want to cover in terms of the challenge for the injured worker is that what underpins all of this is what's the burden of proof. I think David had alluded to that. The burden of proof in workers' compensation is just probability. It's likelihood. And that likelihood standard applies to each element. The worker just has to show that they were likely exposed at work, or that they probably had an increased incidence at work, and they have to show that their illness was likely related to that exposure or probably related to that exposure. The worker's not obligated to eliminate all other potential causes. So community spread may exist, but the fact that there's community spread doesn't mean that the person didn't get it at work, although I hate to use a double negative.
Okay, thanks, Robert, for the extended explanation here. And we're going to get into the distinction between occupational disease and accidents just a little later. So to wrap this part of discussion, David, back to you. If a carrier controverts a claim, how does this play out?
So the rules specify that when a case is controverted, it goes to a pre-hearing conference. We have a expedited trial process in place to try to wrap up controverted cases as quickly as possible, hopefully within 90 days. So we have a pre-hearing conference. At that pre-hearing conference, there needs to be some medical. The reg says a medical report referencing an injury. Doesn't say anything about causal relationship being an element. It just needs to be a medical report referencing an injury. That could be a positive test result or a diagnosis or something else. But we just need something, some medical in order to get to that point. As I said, we don't need causal relationship. It's great if you have it, but we don't need that opinion when you're at the pre-hearing conference. And the way we are looking at these cases is if you have someone, let's say there's only a positive test and that case is in front of you, and they're a nurse or some other frontline worker, then the judge should really, have an inquiry there, ask some questions just to get a sense of, okay, you're a nurse, you work in an emergency room, great. I have that, I have the positive test. That's all I need. That triggers us going to the expedited trial. That triggers the carrier then having the opportunity to get their IME if they want. And then it'll come down to the facts because you've got enough evidence at that point that I'll call it an accident, occurred in the course of employment. So that's enough to get you to the point where if that's all you have, the case is going to be compensable. So I do agree with Rob about the probable side of it, and the claimant does not have that obligation to throw all other causes or really any other causes into disrepute. They just have to make their case, and it is based on probable. And that is true for medical reports as well. One case that I like is from 1996 called Castiglione, and they go into an analysis of what the word probable means, and they specifically said that use of the word probable does not make the medical testimony worthless. You had a claimant's doctor in that case who said that the claimant's illness could have been related to exposure to environmental toxins at work, and that was held to be sufficient. So that's what happens in a controverted case in terms of moving it along. You just need that basic medical, and then, as I said, if it's a nurse or some other type of frontline worker, you are able to have a little basic inquiry, which is not the official testimony in the case. That would happen at the expedited trial, but it's enough to move these things along so they don't get delayed, and we can get the case established as long as the facts support it.
Thanks, David. Both you and Robert touched on a little bit of contrast between occupational disease and accidents, and we know that it's been a lot of focus in Albany on the topic. So, David, can you elaborate a little more on what the differences between the two, occupational disease and accidents, and how might those differences impact the COVID-19 claims? Anything in addition to add? Yeah.
Sure. Well, my basic take is I think the comp law, as written, is built to handle infectious diseases as accidents for the most part. Occupational disease is a concept that, some cases it's very easy to show that distinctive feature of employment, but sometimes that's actually difficult to show. There are lots of cases that get disallowed on the grounds that there's no distinctive feature of employment, whereas accidents are compensable as long as the condition arises out of and in the course of employment. So I'm not saying that these cases, I want to be clear, I'm not saying these cases cannot be ODs. They absolutely can. I totally agree with Rob that a healthcare worker clearly is going to meet the distinctive feature of employment in most cases. And there are cases that say that. There are cases involving infectious disease exposures of medical professionals, and they use the occupational disease route. However, typically they use the route because they need to use the route because of the difference in timing in claims filing measured against both in occupational diseases, measured against the time where the injured worker knew or should have known, and their date of disablement. So the 2-year savings clause helps in occupational disease cases because you're measuring it from that date of disablement, which can be, after the moment of exposure or likely time of exposure. So it could be diagnosis, it could be first lost time. But I think we're going to see many, I don't want to say most because I don't know, many cases being brought within the 2-year framework for the statute of limitations on the accident. So I don't think the time saving is going to be needed in most cases. And it's also worth pointing out, if a case is established as an occupational disease, that doesn't give a claimant extra benefits. And there are cases where it's actually more advantageous to have it as an accident because all of the medical from the date of accident is covered, whereas in occupational disease, it's compensable from the date of disablement. But there are going to be claims that are filed as occupational diseases from COVID and are established as occupational diseases. And I'm sure that in some cases it's going to be necessary to do that. So my main point of view is that I think the accident standard is not going to be onerous to meet for most of the COVID claimants that we're talking about. So I don't know if Rob and I have a severe disagreement on this, because I agree with the basic point that there are plenty of people that can meet the OD standard because they have a distinctive feature.
So Robert, do you have anything to add?
Yeah, I think that most of the differences of opinion that David and I have on this are fairly subtle. There's a different burden of proof for the worker in an occupational disease case than in an accident case. And there are more generous time limitations, as David pointed out. I would tend to disagree philosophically that a worker files a claim as an occupational disease instead of an accident in order to obtain the benefit of the more generous time limitations. To me, the case is what it is, depending on what the nature of the condition is and the cause of the condition is and the worker's occupation. It's properly either an occupational disease or an accident as the law defines these things. But sometimes a claim could be made either way. That's true. I do think that it would be beneficial to workers if the legislature were to address the occupational disease issue for COVID. There is a list in the statute of diseases that the legislature has presumptively determined are occupational diseases for certain occupations. So where that finding has been made by the legislature, the worker starts with the assumption that if they're in that occupation and they have that condition, they win, that there's causal relationship. And in addition to the list of occupations and diseases that are in the statute, the cases over the decades have established many other conditions as occupational diseases. For instance, carpal tunnel syndrome or repetitive strain injuries are not in the statute as an occupational disease, but there are legion decisions from the board and the courts holding the carpal tunnel syndrome or repetitive strain injury as an occupational disease if you're in an occupation that involves repetitive hand use. So really the key point is, if you have an occupational disease claim, all you need to show is that you're in that occupation and that you have that condition, and you have a huge advantage in proving the causal relationship leg of the case, which is where I think a lot of the defense is going to come from here. In our practice at the moment, of the cases where the carrier has responded to a COVID claim, right now 4 out of 5 of them are being controverted. And only 1 out of 5 of them are being voluntarily accepted by the employer or the carrier. I suspect that by the time we get to the end of the road and the board decides these cases, 9 out of 10 or greater are going to wind up being established. But in the meantime, the worker has delay. They're not being paid compensation. They have uncertainty about who's going to pay their medical bills. And this has a significant impact on the worker and their families from an economic perspective. And if the legislature were to address it, then that might grease the wheels here, reduce the number of controversies, and expedite the delivery of benefits, and frankly also benefit the board because it wouldn't have to be adjudicating controversies that wouldn't be filed. I completely agree with David that COVID is going to be an occupational disease for healthcare workers. There really can't be very much debate that the occupation of being a healthcare worker carries with it, as an intrinsic part of the job, exposure to communicable disease and infectious illness. So if you're a healthcare worker and you work in a facility where there's a communicable disease or an infectious illness and you get that, it seems to me to be quite clear that that's an occupational disease. The last point that I would make is that something that I think often gets forgotten these days is the workers' comp law was socioeconomic legislation at the outset. That there was a value judgment here that people who work are going to get injured, they're going to fall ill, there are going to be costs associated with that, and the policy decision that was made is that those costs should be placed on the employer. And the employer then has the ability to buy insurance, so they have a predictable cost, and they can pass that cost on to the customers in the price of the goods and services so that we mutualize the cost of workplace injury and illness. So I think if the legislature were to address COVID as an occupational disease for healthcare workers and essential workers and make it clear that these claims are compensable that way, it would be true to the purpose of the law. It would reduce the number of controversies. It would expedite the delivery of benefits. And it would just get us to the same place that we're probably going to get to in the end, only faster and with a lot less pain and suffering along the way.
Well, thanks, Robert. Now let's turn to medical care. So we're still very much learning about the COVID-19 disease. And there's a lot more that we don't know than we do, such as why the coronavirus impacts some severely and leaves others asymptomatic. Let's begin to sort through it. Dr. Packman, much of the medical costs related to COVID-19 will be paid out when the disease is initially contracted and will likely consist of primary care visits, hospitalizations, and the like. What do you think are some possible long-term medical issues and costs that should also be accounted for?
Well, thanks, Gua, for having me here. So it's generally been estimated that the cost of care, approximately, if an injured worker is diagnosed with COVID and placed on a ventilator, is about $200,000. We know that only about 30% of hospitalized patients require ventilation treatment. The majority of claims to date have been relatively contained cost-wise from a medical point of view. However, based on our prior experience with the SARS epidemic 20 years ago, which is the basis for much of our modeling now, and some preliminary recent follow-up studies of COVID-19, there's the potential for a long-term tail related not only to the lung, but to the heart, kidneys, and possibly the brain. And there's also the potential for psychiatric comorbidity.
So now, could these long-term health impairments hinder future employment, in your opinion?
Yeah, there definitely is that potential. In the group disability space, my medical colleagues tell me that they are already receiving claims related to chronic fatigue or chronic fatigue-like syndrome. Neurologists have discussed a post-concussive-like syndrome that's apart from the established post-ventilator ICU syndrome. Obviously, these type of symptoms are often subjective, and we know difficult to predict the prognosis or the impact of related psychosocial or economic drivers. And there's also the potential for blood clot formation, as we know from COVID. So we might be seeing future claims for deep vein thrombosis and maybe even heart attacks.
Generally, orthopedic injuries are most common injuries among injured workers. Not surprisingly, over the time, orthopedic injuries and treatments have been a focus of workers' compensation policymaking efforts. So, Dr. Packman, does treating those suffering from COVID-19, which presents so differently than traditional workers' compensation injuries, present a challenge to the existing workers' compensation system? And what are those challenges, and what are some ways to overcome them?
Yeah, for me, in many ways, the situation is in some ways potentially analogous to the World Trade Center claims that we continue to receive. There's a long latency period, potentially. There's many unknowns regarding long-term consequences. There's challenging economic conditions and job market, and there's understandably sympathetic injured workers, as well as legitimate questions related to causality from a medical point of view, potentially, particularly related to some of the long-term tail medical problems. So I think it's going to be very challenging.
Let's see. So now let's talk briefly about the pandemic's impact on medical treatment for existing claims. For the many workers who suffered injuries and began treatment prior to the pandemic, with delays in treatments caused by the stay-at-home order, resulting setbacks for them. So Dr. Packman.
Yeah, so most of the surgeries that we encounter in workers' comp are orthopedic in nature, generally related to the shoulder and the knee. In most instances, apart from situations that involve a fracture or an infection, these are not emergent decisions. So they were delayed with treatment with tele-everything. So obviously there was an impact on indemnity, but to the extent that treatment delayed is treatment denied, some argue that delayed surgical care might result ultimately in potentially worse outcomes. But we really won't know until the backlog is worked through to a much greater extent. We might also have a quasi-experiment related to the potential for prolonged conservative treatment in some instances compared to surgery, such as the case of meniscectomies, and the potential for a lower rate of surgeries to follow, such as knee replacements that are presumed to be related to the meniscectomy, for example.
Well, thanks, Dr. Packman.
Sure.
Now let's change gear for a few minutes and to talk about data and claim experience. So, Ben, preliminary data obtained by the rating board indicates that there has been a significant decrease in the number of workers' compensation claims filed. There are likely a variety of reasons for this change, such as an increase in unemployment, Governor Cuomo's stay-at-home order, working from home, and safety protocols. Now, a decrease in the number of claims filed could impact the future loss cost filings. How do rating bureaus deal with changes in claim activity and possibly frequency precipitated by the pandemic? I know this is a complex question. Ben, can you unpack it for us?
Sure, Gua. First, I think it's important to understand the relationship between claims filed and the frequency that is utilized in the derivation of loss costs. Frequency measures the relationship between claim count and premium, whereas claims filed reflects the raw claim count irrespective of premium. When we see that claims filed are dropping, the first question we ask is whether the payroll and the associated workers' compensation premium are also dropping to the same degree. If the number of claims filed and the premium are all decreasing at the same rate, then the frequency, meaning the number of claims filed per $1 million of premium, will remain stable. And while we know that there has been a decrease in claim activity, we also know that there will be a decrease in premium due to a variety of changes in the workplace, including the transition to a work-from-home environment, which carries relatively low loss costs. The big question here is whether payroll and the premiums decreased at the same level as claim activity. If the decrease in claim activity does not decrease at the same rate in premium, then the 2020 frequency may be very different from where it has historically been. And because 2020 has been so unique, 2020 claim frequency may not necessarily be indicative of what will happen in 2021 and 2022. This brings me to my next point. It is important to understand the purpose of our loss cost filings to drive loss costs that are appropriate for future experience, to ensure that the loss costs are sufficient for losses incurred under future policies. When deriving loss costs for these future years, rating bureaus traditionally utilize historical data and economic assumptions together with actuarial methodologies to generate a prediction of future experience. The big question here is whether the 2020 experience will be predictive of what will happen in 2021 and 2022, and how quickly the economy will recover from this recession. If we think that the current economic conditions, including the shift to a work from home environment, will continue for the foreseeable future into 2021 and 2022, then it may be permissible to allow the changes in frequency observed in 2020 to flow through the model. On the other hand, if we think that the pandemic will be resolved in the near term and that the risk of injury will return to pre-pandemic levels, it may be appropriate to factor that one in as well.
Thanks, Ben. All indications point toward a very different claim experience in 2020. Dr. Packman, many workplaces now have transitioned to remote operations, and a significant number of people are now working out of their homes. What types of injuries and claims do you think we will see as a result?
Yeah, so we know that approximately 1/3 of workers' comp injuries, as estimated by OSHA, have ergonomic dimensions. So the ergonomic workstation issues are likely to be of the most significant concern for people working from home. Workers might not have access to monitors or keyboards or headphones. They may forget to get up and change their posture, since the more natural breaks that usually occur, like going to a meeting or walking to a printer, won't exist. So I think it's important to deliberately incorporate movement into the day, take a walk while taking a conference call, that kind of thing. I think that employers are going to need to think about more long-term solutions and offer maybe potentially some different types of equipment to workers. Then there's the potential for trips and falls that are present in the home. I'm looking around in my home office. I don't know if you could see it, but I'm seeing some things that maybe I need to take a look at and change. Some electrical cords and equipment that are potential hazards. I think people also need to set boundaries on work time and home time, set up a routine, shut down the computer, set relaxation and decompression time with exercise and that kind of thing as well.
So now, Dr. Packman, do you think we will see significant mental health claims filed by frontline workers? And what types of outcomes can we expect?
Yeah, so mental health and well-being are always a concern, and people always struggle with perceived loss of control and uncertainty. I mean, all of us do. So I actually wear two hats, as you had mentioned. I'm a licensed psychologist as well as a licensed physician. So this issue of mental health claims and the potential impact is a particular concern to me. In China, where the disease struck first, and so we have more data, approximately 10 to 15% of healthcare workers have reported disabling symptoms consistent with anxiety and depression. Over a third reported symptoms consistent with PTSD. Over a third reported psychiatric symptoms in general. And again, I'm talking about healthcare workers. But some of the symptoms were insomnia, impaired concentration, memory impairment, in addition to the anxiety and depression. And again, from this data, injured workers with pre-existing psychiatric comorbidities reported a worsening 20% of the time. And there's also been some reports of, in general, of increased opiate overdoses associated with the pandemic.
Thank you, Dr. Packman.
Sure.
Now, it's easy to see how COVID-19 might exact a toll on workers, but we may also see other types of claims in the system. Robert, and back to you. What do you think if there's a possibility for consequential claims? And what might those claims look like?
Oh, I think there are most definitely going to be consequential injury claims stemming from people who have COVID-19 related illness. And I think that those claims are going to take many different forms. There's no question that there are going to be claims for consequential mental health disorders. We see that already in the existing system when people have physical injuries and they have adjustment disorders or major depression, secondary to the physical injury and disability and the loss of income. And, those sorts of claims are routinely compensated. And I suspect that they'll be routinely compensated as consequential injuries for people who are diagnosed and were disabled with COVID-19. As Dr. Packman alluded to, the science on the long-term consequences of COVID-19 from a physical standpoint is still developing. I've seen some reports in the last couple of weeks about myocarditis being a consequential result. There's some evidence regarding blood clots. I'm not qualified to comment on all of the different physical and medical consequences that may result here. But I think that there's no question that there's going to be a wide variety of secondary medical problems and conditions, both physical and mental, that are going to result from COVID-19 infection, and that consequential injury claims and in some of the more significant cases, consequential death claims are going to be presented for adjudication by the board for many, many, many years to come. The direct mental health claims are going to be a separate matter. Those aren't consequential claims, but if we have healthcare workers who were working in, for example, in Montefiore Hospital, which was close to a war zone during the pandemic, or other facilities that were overwhelmed, I think that we may very well see claims for people who do not have, were not infected with the virus, but have mental health consequences that are a direct result of the work that they did during the height of the crisis. I think those are going to be presented as accident claims for adjudication by the board. So, somebody earlier mentioned the World Trade Center as an analogy. I think it was Dr. Packman. I think that's a good analogy in terms of that we're still dealing 20 years later with World Trade Center claims, some of the issues in those claims, some of the consequential injuries that are arising from those. I think one key difference between the World Trade Center experience and COVID is that a lot of the medical treatment for World Trade Center patients was expedited eventually as a result of the World Trade Center health program. So those folks were able to get access to medical care without necessarily fighting their way through disputes and workers' compensation, because the World Trade Center health program was there to cover that. Thus far, we don't have an equivalent for workers' compensation. And I think that creating adequate medical resources and access to adequate medical resources is going to be a significant challenge for the board now and going forward.
See. So, David, any thoughts on consequential claims?
I agree with what the way Rob characterized it. The only thing I'll note in addition is I think on the tragic consequential death claims, there's going to be two kinds of them. I think we'll see ones that arise in the relative near term that you can clearly show the trajectory, how it affected the renal system, the heart, the lungs, etc. But you're also going to see these claims down the road because we just don't know yet what kind of impact it's going to have long term. And with death cases in workers' comp, if you have a compensable claim and you die, it just needs to be a contributing cause or a proximate cause. It doesn't need to be the cause. There's no way to parse out or apportion the causation there. So I think we're going to see, an unknown second type of consequential death in these cases down the road, unfortunately.
Okay. So now, Dr. Packman, you alluded earlier, but maybe you can elaborate a little more here. Could a health impact of the COVID-19 turn into a comorbidity for other types of workers' compensation claims?
I think, the potential exists, and as Rob and others have mentioned, the data is still developing, but we do know, or is believed, that COVID-19 at least has the potential to suppress the immune system. So there might be claims related to an increased risk for future infections. Again, looking at prior epidemics, evidence from MERS, which is another coronavirus, was that there was an increased risk for things like TB, which we've discussed here, as well as even the flu. So it's just very difficult right now to, with confidence, predict how that's going to play out.
Losses incurred due to pandemics were not contemplated in previous loss cost filings, but they're here nonetheless. Ben, how should the workers' compensation system account for losses that resulted from the pandemic? What are the options, and what are the advantages and disadvantages of the different approaches?
Again, I want to emphasize that rate making is prospective in nature. In other words, when we file loss costs, we're trying to predict what losses will be in the future effective period. We do not and cannot attempt to recoup losses from past policy periods. So the appropriate question to ask is whether we can expect COVID-19 losses to be likely in the future filing period. How likely it is for these losses to recur during the prospective filing period will hinge on a variety of factors, such as how soon the vaccine becomes available, are therapeutic treatments available to help people recover from the COVID-19 disease, as well as whether the public engages in safety measures that decrease virus transmission, such as mask wearing and social distancing. One option available to rating organizations is to exclude all COVID-19 claims from the experience. Doing so requires the assumption that COVID-19 is a one-time event unlikely to recur in the future policy periods. The advantage of this approach is that loss costs will be more stable, especially in occupational classifications that are more susceptible to pandemic-related injuries, such as the healthcare industry. The disadvantage of this approach is that if COVID-19 losses do appear in the future filing period, they are not being appropriately covered by the premiums charged. Now, policymakers can consider establishing a separate mechanism to address the risk of pandemic losses. Such a mechanism may include a separate charge on all policies or a subset of policies, similar to the terrorism charge. Policymakers can also call for the establishment of a pool or fund, or the creation of some sort of cost-sharing mechanism between carriers and governments. We look to the policymakers in the state of New York to determine the best way forward for our marketplace.
Thanks, Ben. Now, states have reopened in varying degrees. Commuting to work and operating work environments are now inundated with safety protocols and procedures. It's not difficult to see how changes in the workplace could impact workers' compensation. Now let's talk about the changing workplace. Howard, when employers open up the workplace during this pandemic, what will be the obligations placed on them from an OSHA standpoint?
Hi, good morning, Gua. Thanks. The United States Occupational Safety and Health Administration has not promulgated any emergency temporary standards, which are effectively temporary laws that would have set forth requirements for what employers must do to create and maintain a safe workplace with respect to COVID-19. Rather, OSHA has relied on the General Duties Clause, which requires employers to provide a workplace that is free from recognized hazards, and OSHA has issued non-binding guidance, including guidance on returning to work. Now, one of the odd aspects of this is that OSHA has made a variety of non-binding recommendations. We see that employers are recommended to establish a disease preparedness and response plan. The employer is recommended to establish preventative programs, including things like regularly cleaning the workplace, deep clean in the event of a positive case of COVID-19, promote good hygiene, facilitate social distance of at least 6 feet, teach employees about masks. That's something that OSHA does. Indeed, today I received my OSHA tip of the day for COVID-19, and it's the recommendation today is that we train workers on safely wearing cloth face coverings. Now, that is very elementary. We're 6 months in to the pandemic. And so if you think about that, I was struck by how basic that recommendation was when it hit my email at early this morning. And so clearly, I think that demonstrates that OSHA's voluntary guidance here has not been as aggressive and as helpful as many would have wanted. I mean, certainly employers have to conduct a hazard assessment to determine what is the appropriate level of PPE for their workplace. A confirmed case of COVID-related, a confirmed case of work-related COVID-19 is a reportable workplace illness on OSHA Form 300, which is something that employers of 10 or more employees have to complete. So if an employee contracts COVID-19, the employer at a minimum has to do a reasonable good faith investigation to determine work-relatedness. For example, speaking to the employee and asking that individual where he or she thought they contracted the virus, talking to that person about their activities both inside and outside of work. And quite frankly, that is an uncomfortable conversation because you're going to talk to employees about, gee, did you go to any parties where people weren't socially distancing, where people weren't wearing masks? Did you go to an indoor restaurant, assuming that it's permitted in the jurisdiction where the employee spends some time? And then, of course, to review the workplace itself. For example, there may have been a cluster of positive cases at a particular workforce. The bottom line here is that in the absence of uniform mandates coming from OSHA, states have filled the breach, including New York. And so, although they're labeled as guidance, we have seen New York promulgate very significant detailed requirements that employers must meet in order to reopen. Employers are required to provide face coverings, masks, both initially to get the employees started and then provide them on a no expense basis as replacements. Employers are training employees about how to use and discard PPE, whether it's a mask or gloves. Employers in New York are required generally to limit occupancy to 50%. And that includes both the employees themselves as well as guests and visitors, including customers. To establish markings on the floor to facilitate social distancing. In hallways, they're pretty narrow, certainly in New York City, so it's difficult to have the 6 feet. So it's encouraged that employers have one way, perhaps going clockwise all the time, so as to ensure that people are having that space between them. And then there's the daily health certification. At a minimum, employees and guests have to self-certify and answer 3 questions every day. that they knowingly haven't been in close and proximate contact with someone in the last 14 days who's either tested positive or exhibited symptoms, that they themselves haven't tested positive in the last 14 days or exhibited symptoms. And then there are requirements for reporting to the state and local departments of health so as to ensure contact tracing. So what I'm suggesting here is that while OSHA does have certain application, because OSHA has not promulgated ETSs, these temporary standards, the states, including New York, and particularly New York, have certainly filled that breach.
Thanks, Howard. David, how do these obligations, including the ones that Howard added from a state aspect, and perhaps failing to live up to them, impact the workers' compensation claims?
I think there's a couple of different sides to that. On the one hand, you take the claimant as you find them. The existence of these obligations is irrelevant really as to whether something is work-related, and comp is no fault. On the other hand, though, if you have an employer that's not taking safety precautions, not disinfecting, not creating the conditions for distancing, not having a mask requirement, these are facts, and this could go to the issue of prevalence and could affect compensability if the claimant's able to show that they're in that kind of a workplace. But I think the fact that an employer is going to argue that they are compliant with these obligations doesn't have an impact per se on making the case less compensable. But again, I think it's certainly a fact as to what kind of work environment the employee works in.
Thanks, David. Now, Dr. Packman, do you think the PPE or personal protective equipment should be required in the workplace?
Well, I think first that it's important not to conflate laboratory models of aerosol generation that we've all seen with transmission. But that said, using face coverings of the nose and mouth definitely help to spread the spread of the respiratory droplets. So we know, for example, from the experience at the Missouri Beauty Salon, in which both stylists were unknowingly positive, but both were masked, they didn't result in any known transmission to the patrons, who were also masked. But in order to reduce transmission and keep the workplace safe, I think we're going to need to really be looking at several actions, not just one, as people have alluded to. Revising the jobs, the number of people in the office, maybe staggered shifts, maybe alternating weeks, physical distancing barriers, shields, limiting meeting attendance, improving disinfection, looking at better air exchange, HVAC systems, etc. We know that in general, with these kinds of things, engineering measures are generally better than administrative measures. We've spoken about wearing masks, but I've seen several instances of mask fatigue where people start wearing masks at work and then just stop. We've also heard from some construction workers that there's concern about their protective eyewear fogging when they're wearing masks. There's concern about contained spaces such as elevators and common gathering areas. So, some people need to kind of take a look. It's all about risk mitigation. And if some injured workers are just going to be, some workers that is, are going to be more comfortable with social distancing and masking. So it's reasonable to ask, is it necessary to return to work? What's the advantages if someone can work from home? Daily temperature checks are going to be really only of limited value. 40% of infected people are asymptomatic. It's been likened to kind of catching tennis balls with a soccer net. The best solution would be rapid daily testing, even with pooled samples, but we're not there yet. Also, some people have discussed using reusable N95 masks. That would also help, but it's just not widely available. Plus or minus the ability to decontaminate the masks. So the bottom line is, the answer to your question, yes, masks will definitely help, but it's certainly not going to be enough.
Thanks, Dr. Packman. Howard, the challenges of reopening may lead to claims and lawsuits against employers related to PPE or other health and safety measures. Does exclusivity of workers' compensation as a sole remedy available to employees bar these lawsuits?
We certainly have seen a fair number of COVID-19 related tort claims that have been filed. Initially, they were against high-profile employers, Walmart, McDonald's, Safeway, and they asserted that the companies failed to protect the workers from COVID-19, including allegations of inadequate PPE. I remember reading a press account of one of the lawsuits, and the allegation was that the employer instructed employees to use a coffee filter as a face mask, which is just incredible. And so clearly those lawsuits have been filed. More recently, I've seen them filed against smaller employers. And so I do think that we will see a significant number of those claims filed over time. Now, if based on the criteria that David and Robert discussed earlier, that there is a compensable COVID-19 accidental injury or occupational disease, then under traditional workers' compensation law principles, workers' compensation will be the exclusive remedy and bar tort claims by the employee or the employee's representative, including family members, unless one of the long-standing, well-recognized exceptions apply. The two that come to mind as potential exceptions are the intentional tort exception, and that speaks to intentional or deliberate act by the employer or someone acting on the employer's behalf. So mere knowledge or appreciation of the risk isn't sufficient. You would need to show, I believe, that the employer intended to infect the employees in order to fall within that exception. And if that's the case, then that is going to be difficult to demonstrate. I believe that contribution and indemnity to a third party is a much more likely exception. And that's where the employer may be liable for contribution or indemnity to a third party, such as a landlord who, as Dr. Packman mentioned, ought to have increased airflow or limit the number of tenants and guests who can get in the elevator to 4, so that you didn't have that congestion in the elevator to try to stop community spread. So if the landlord didn't do that, and the landlord is sued by someone who contracts COVID-19, and then the landlord brings a third-party claim for contribution or indemnity against the employer for grave injuries, such as death or permanent loss of use or a body part, I believe that that's a possible way around exclusivity, and that may well apply. Now, please keep in mind that even if you do have exclusivity, it's not going to bar discrimination claims. For example, under the Americans with Disabilities Act and the New York State and City human rights laws, for example, employers have a duty to accommodate individuals who have disabilities, so underlying medical conditions. And those individuals may be entitled to a work from home accommodation. And if an employer failed to do so, that would be a basis for bringing a claim against the employer, and that would not be barred by the workers' comp exclusive remedy doctrine. Nor would retaliation claims under OSHA or under the National Labor Relations Act or analogous state or local laws. And so those claims would proceed without respect to the exclusivity doctrine.
Thanks, Howard. Now, David, what are your thoughts on exclusivity and safety-related claims against employers during this pandemic?
Well, I think exclusivity is definitely going to be a factor in evaluating suits, which, they're not brought before the Workers' Comp Board. So this is not technically in my direct area, but in looking at those suits, you have to take Section 11 of the Comp Law into consideration, even if those suits relate to, let's say, securing, PPE or suits that the workplace is unsafe. One of the more interesting cases in this area is a First Department case from 1993 against Con Ed called Acevedo. And that involved Con Ed workers who, after a steam pipe explosion, were called in to clean it up. And they were reluctant unless they were given a higher standard of personal protective equipment. So they sued. And one of the interesting questions, the most interesting question, I think, for our purposes here, is that lawsuit had nothing to do with an injury. It was, they were just looking for better protective equipment. But the rationale the court used was that even though this doesn't involve an injury per se, if an injury occurred because of lack of PPE in that circumstance, from exposure to asbestos in that case, then it would be within the exclusive domain of the Workers' Comp Board, and therefore Section 11 applied to bar the claim. So that's a separate ground from the intentional tort ground. It's really the prospect of an injury ground that triggered Section 11, and I think that's a case. Again, it's not a Court of Appeals case, it's a First Department case, but it's one that I'm certain will come up in claims of exclusivity by employers. I agree with Howard that other claims, be they related to labor relations or discrimination under the Americans with Disability Act or civil rights, they are separate, and I think they will proceed.
Thanks, David. Now, Robert, do you agree with David and Howard, and do you have anything to add?
I generally agree with both David and Howard, although less diplomatically. I think the Acevedo case, when you boil it down, is really saying that there's no private right of action to go do OSHA's job for it and create workplace safety regulations. And that's especially relevant in the current state of affairs, where OSHA is completely and totally derelict in its duty here. In the face of a pandemic that's clearly creating a workplace hazard to millions of workers, OSHA's done exactly nothing. Now, with regard to a worker who contracts COVID while on the job, their exclusive remedy is going to be their workers' compensation claim with regard to the employer. We have in New York probably the strongest exclusive remedy rule in the country. Other states, there are exceptions to exclusive remedy for gross negligence or violation of safety laws. And in New York, we do not have any of that. A case I thought David might mention and help me out by remembering the name of the case was from the 1970s. There was a thermometer factory where the workers were exposed to mercury due to unsafe working conditions. There were deaths as a result of the exposure. The owners of the factory were convicted of manslaughter. There was a direct action brought against the employer on the not outlandish theory that if the employer was guilty of criminal manslaughter, then they should be also responsible in tort. And the outcome of that case was that because intent is not an element of manslaughter, the direct action against the employer was dismissed. Howard makes an excellent point that there may be cases where the worker can sue a third party and the third party may implead the employer. However, I think that the number of those cases that involve grave injury is likely to be fairly insignificant. There'll probably be a very, very small number of grave injury cases where there's impleader that reaches the workers' comp policy under 1B. I think to the extent there are third-party actions that result in impleaders of employers, there will probably be contractual indemnification provisions that come into play. One of the examples that was thrown out was a lease with a landlord. Most leases contain indemnification provisions. Where the employer is being impleaded, under a contractual indemnification provision, that is not going to run to the workers' comp carrier. That'll run to the general liability carrier and would in fact be a benefit to the workers' comp carrier because then they'll have lien recovery and credit. So I'm not sure that there's going to be, I agree with David and Howard that there probably will be a lot of claims for personal injury against employers, either directly or indirectly. I suspect that when you sift through all of those claims to the ultimate conclusion, very few of them will result in recoveries. And to the extent that there are recoveries, enough of those are going to fall under contractual indemnification that the employer, the workers' comp carrier gets lien reimbursement for, that it'll probably be a net wash from a workers' comp standpoint.
Thanks, Robert. Now, Howard, what can employers say to staff who voice safety concerns returning to work? Can employers force the employees who have shown that they can work remotely returning to the work site? Does the calculus change if a particular employee has an underlying health condition, is older, say age 65, or is pregnant?
There's a lot there, so let me take it step by step. In terms of what you say, let's start with what you shouldn't do. You should not discipline or discharge someone who questions health and safety protocols or makes the safety-related complaint. Under OSHA, the Occupational Safety and Health Act, employees lawfully may refuse to perform work if they have a reasonable good faith belief that they'll be exposed to imminent risk of death or serious injury. Now, that is a very, very high standard. So that typically doesn't come into play. But OSHA also prohibits retaliation against employees who make complaints about safety. The National Labor Relations Act protects all employees, whether or not they're members of a union, so that they have the right to engage in what are technically called protected concerted activities, what I would describe as the right to discuss or act together about issues of workplace concern, and that includes safety issues. And so if an employer or a supervisor were to discipline or terminate a staff member who questions health and safety protocols or makes a health and safety complaint, the employer is likely going to violate the National Labor Relations Act, OSHA, and analogous state or local laws. What an employer should do is take the concern seriously and have a dialogue. So an employer may say, look, we opened up and we're in compliance with all of the state's mandates. And we brought in an expert who assessed our workplace, and here's what we've done. And spend the time to explain to the employee that we've cut occupancy by 50%. We now, as I believe Dr. Packman earlier had mentioned, have an A and a B team. Employees are on for a week or 2 weeks at a time, and then they work from home. We've increased the ventilation. We've put up plexiglass. In some instances, people, rather than provide a mask, they're providing a shield, a plexiglass shield that covers their face. And then you talk to them and you say, what else, if anything, can we do that might address your concern? Now, sometimes there are just structural things that you can't address. So someone may say, look, it's not the workplace, it's getting to work. I need to get on the subway and I'm uncomfortable doing that because few people have the luxury of walking or riding a bicycle to work. And so that is a hurdle that there aren't very many practical solutions for, but I do believe dialogue is the best way to go. Now, in terms of forcing people to return who can successfully work remotely. Generally, employers do not have an obligation to permit teleworking or telecommuting, but there certainly are instances when that's required or may be required, and you've identified them. So let's start with some basics. There are certain businesses that currently are not able to operate in person in New York State. And so if you are one of those businesses and your employer says come to work, then clearly the employee does not have to go to work. In most cases right now, businesses in New York State are permitted to be open, provided that the employer meets a variety of health and safety guidelines that many of us have discussed this morning, including, as we've mentioned now, that occupancy is limited to 50%. And so if the employer is meeting that, then you can have somebody come to work. Now, if an employer isn't, then employees are encouraged to file complaints with the New York State Department of Labor. There's a link on the New York State Department of Labor website to take in complaints. Now, turning to areas where employers have a duty potentially to accommodate folks who are age 65 and older, pregnant, who have underlying medical conditions. The CDC has recognized that those folks are at risk for severe outcomes if they contract COVID-19. And under the Americans with Disabilities Act and analogous provisions under the New York State and city human rights laws, employers are required to provide reasonable accommodations that enable employees to perform the essential functions of their job unless the employer can demonstrate undue hardship, that is, significant difficulty or expense. And working remote is a potential accommodation. Now, I will tell you that for years, the EEOC identified remote work as a potential accommodation. And the EEOC, the Equal Employment Opportunity Commission, in federal court litigation, had mixed results in enforcing that in effect as a remedy. I will tell you that if I look in my crystal ball, I believe that the EEOC will have much greater success. Us, including courts and judges, have successfully worked remotely for the past 6 months. So I do believe that that will be something that is greeted with a greater reception, a much more favorable reception on a going forward basis. So look, if someone can do the lion's share of his or her job and the person has an underlying health condition, then as an accommodation, the employer is going to have that person, be required to have that person to continue to work remotely. Now, interestingly, under federal law and under the city human rights law, if an employee does not have a disability and underlying medical condition, but someone with whom the employee lives, such as an elderly parent does, have an underlying medical condition, there is no obligation for the employer to accommodate that employee and to permit him or her to continue to work from home. However, New York State seemingly provides a greater protection. Employees, again, on the New York State Department of Labor website are invited to bring a complaint, to file a complaint, if a family member is part of a vulnerable population, and that includes family members with underlying health conditions. And although it's not specified, I believe the source of this are executive orders that the governor has signed. One was Matilda's Law, named after the governor's mother, that provided certain precautionary steps that elderly people who are part of vulnerable populations should take, and Executive Order 202.8, which basically required that employers that were non-essential permit telecommuting to the greatest extent possible. And those have been effectively modified to permit working on site at 50%. But that certainly would seem to be the basis for those New York State Department of Labor complaints. Now, in terms of age, the Equal Employment Opportunity Commission has recently opined that employers do not have a legal obligation to accommodate older workers under the Age Discrimination in Employment Act, which protects against age discrimination for those age 40 and above. However, the EEOC just opined that employers, if they provide flexibility, such as working from home for those age 65 and above, which has the practical effect of disadvantaging those between age 40 and 64, then the EEOC would not view that as age discrimination. Now, the New York City Commission on Human Rights has taken a different tact. It notes that in New York City, the New York City human rights law protects all workers from age discrimination regardless of age. So providing accommodation to older workers, even though it's not mandated, would violate the New York City human rights law. Now, the City Human Rights Commission's workaround there is to recommend that if an employee who says, hey, I need an accommodation because I'm age 65, I'm at risk for a severe outcome, the City Commission has advised employers to tell employees, look, you may be able to get an accommodation if you have an underlying medical condition. And certainly pregnant employees are entitled to accommodations under a variety of federal, state, and local laws. And one of those accommodations, again, and perhaps the most likely one, would be working from home.
Well, thanks, Howard, for the loaded answer. Now, if and when a vaccine becomes available, can employers require employees to get vaccinated?
Well, here I'm going to give you a very direct answer, and that's no. And now I'll give you a little more detailed. Employers, whenever it comes to vaccines, whether it's a flu vaccine or other vaccines, employers should expect employees to make requests for accommodations based on medical conditions. For example, potential allergic reactions to the ingredients, or sincerely held religious beliefs. Someone may say, look, I'm a member of a particular religious group, and I have a sincerely held religious belief, and we just don't get vaccines. Now, I will tell you that when the EEOC last looked at this with H1N1, the so-called swine flu, the EEOC advised that employers could not compel employees to take influenza vaccines, regardless of medical conditions or religious beliefs during a pandemic. That's quite a statement. That means that even if someone didn't assert a medical or religious accommodation, the employer still couldn't require that the employee take the vaccine, even during a pandemic. Now here, we're speculating, because right now there is no vaccine that's been approved, and it's possible that there will be one in the next 6 months. There's certainly been press accounts that suggest that. And we don't know whether the EEOC is going to follow its prior guidance with H1N1 with swine flu here, because it's possible that the EEOC will say, you know what, community spread is so great and the risk of severe outcomes is so serious that we're going to treat this as a direct threat to the health and safety of coworkers. So someone who doesn't take the vaccine perhaps won't be able to come back to work. That's a possibility. I'm speculating both as to whether a vaccine will be available and the position and guidance that we'll see from the EEOC. And I would also encourage you to look for guidance from the New York State Division on Human Rights and the New York City Commission on Human Rights to see if they follow EEOC guidance or if they set their own path, which on occasion they have done in this area.
Thanks, Howard. We'll definitely, it would be nice to have a vaccine to become available sometime soon, but we will see how effective it will be and whether we will have to get vaccinated or not. So now, as we know, there are a variety of other federal, state, local laws and ordinances providing paid time off for workers impacted by COVID-19. In addition, many employers have rolled out additional leave policies related to the pandemic. Now let's dial back to losses and loss costs. Ben, have these leave policies reduced the number of claims? If so, what's the impact?
Yeah, the short answer is that the data that we have thus far, some of it anecdotal, suggests that these programs have reduced the number of claims filed. However, I caution that workers who suffer significantly from COVID-19, meaning that they're on an ICU or on a ventilator, they're more likely to file a workers' compensation claim regardless of the availability of additional paid time off. These new laws and company policies may very well reduce the number of claims filed for workers who suffer from less severe illness. For example, New York State passed legislation to provide at least 5 days of paid time off for employees if they or their family members need to be quarantined. And the amount of required time off varies depending upon employer size and revenue. Anecdotally, we understand that some companies who implemented generous paid leave policies have had very few staff members file workers' compensation claims. And it certainly stands to reason that these policies eliminated the need for the claim. There may also be workers who decide against filing a workers' compensation claim because utilizing those benefits would reduce their income, whereas using paid time off would not. Others may forego the benefit altogether because they don't want to engage in the process of filing a claim. So these paid leave law programs and other programs, in combination with the worker's decision to file or not file a claim, will all contribute to the final COVID-19 claim level. As of today, it's too early to determine the extent to which these laws have on claims filing activity. But preliminary data suggests that the total number of workers' compensation cases filed is a small percentage of the total infections reported by the state of New York.
Thanks, Ben. That concludes our discussion today. I want to thank all of our panelists for taking the time to join our discussion today. We very much appreciate your time. For those of you watching via virtual stream, thank you for tuning in. And we hope that this discussion provided insight into the challenges lay ahead in the New York workers' compensation system. Thank you.
Thank you, Gua. On behalf of the Rating Board, I want to express our gratitude to our presenters and panelists and all those who joined us in today's virtually streamed Workers' Compensation Forum. I hope that you enjoyed today's forum and use what you learned in a meaningful way, and that we all continue to work together to improve the system and make workplaces safer for New Yorkers. You will soon receive a survey by email asking you to comment on your experience today and suggest topics for future research. Please complete the survey so that we can continue to improve the experience next year. Thank you,